On the upside. So it seems strange to be going into a rate cutting cycle with the data maybe bottoming out and turning better.
The data in China a little bit better on the exports. I'm watching as well the miners on the back of iron ore. They've got a bit of a pop, the housing story as well, evolving in China. So I think we should watch the miners as well, see if there's a reaction there.
Especially as that was one of the worst performing sectors yesterday. So European equity markets then just getting up and trading. The FTSE 100 is out of the gates and not moving anywhere really. We're waiting for the Bank of England rate decision, of course. That's not that the FTSE really reflects the UK economy, but we're waiting for that in terms of UK news flow still to come. We've got the European equity markets more broadly then showing a little bit of downside. The DAX is flat. The IBEX appears to be down by 0.4%. Of course, the Spanish banking sector is very much in focus today.
BVA is down by 5.25%.
Yeah.
That's where the weight's coming from. Sabadell is higher. It does seem as if the market is now maybe believing that this deal could be possible.
Well, that's interesting because we get another rejection. I'm just seeing across the Bloomberg terminal, Sabadell rejects BBVA takeover.
But isn't that the whole point? That they have rejected it. We're not listening to you anymore. We're talking to your investors.
But this appears to be new. I mean, they're saying it again, but it's what they've said.
So it's a 13% premium is the offer on the all share price. So you're getting, as you say, a 6% pop in Sabadell. BBVA obviously and expectedly feeling a little pressure on this. So we continue to keep across that story. The rejection again coming through on the back of that hostile takeover. So the consolidation story again, as we've been talking about the banking space in Spain and how that evolves. Broadly across the other sectors then that we're looking at in terms of the upside coming through, energy up 0.3, personal care also getting a modest lift. But again, the downside, interestingly, coming through from autos, well, and that's a bit of profit taking after the gains that we saw yesterday, down 1.5% so far on autos. So we'll see how that shifts, if at all, through the session.
The car sector, the car sector's increasing. I find it really interesting. The talk of what is happening around China as well, I think, is fascinating. It's interesting that Volkswagen is out basically saying to the European Union, to the German government, don't put import restrictions on Chinese cars, because ultimately I think they're worried about the reciprocal impact that that can have and how it just flags how important China is to Volkswagen, some of these bigger groups, that they need to kind of regain their momentum in that market. And if they don't at this critical juncture, then that could be a real struggle to regain the momentum. So the Volkswagen's clearly worried, and maybe it actually is. It's more worried about not getting access to the Chinese market
than the
Chinese getting access to the European market.
We have an incredible lack of visibility around where if profits are being made. Obviously they are in the auto sector. We have a real lack of visibility as to how those are allocated across different players based on geopolitics. There's such geopolitical threats hanging over that sector, and you could argue other sectors as well. Medical devices is one that's currently being investigated as well.
Yeah, absolutely. And in terms of the repatriation of profits from those businesses that are located in China as well, and whether that's a challenge more acute going forward. So we continue to keep across that story as well. The Bank of England obviously is going to be a factor in terms of the UK assets, so we look at gilts as well. Obviously the reaction function going to be more acute when the detail comes through at 12 o'clock, but currently you're seeing no movement essentially across gilts, just 1 basis point move higher at the front end, and that's potentially where it's going to be more sensitive at 4.31 on gilts.
It's a confusing morning. I suppose we're in a holding pattern, aren't we, really? Waiting for the Bank of England, what are we waiting for? Waiting for inflation data next week. Always waiting for something. I think the inflation data next week out the US is not supposed to tick down hugely. It's supposed to go from 3.5% down to 3.4%. So we are, we're not looking for a huge move there.
Let's talk about the wider picture around what is happening with markets. We have wrapped up the big conference out in California. We've had some great sound coming from the Milken conference over the last few days. Kathleen McCarthy, Blackstone, talking about what is happening with the market in terms of how she sees how the story around property, how the wider markets have played out. She feels that that story is now beginning to bottom out. Let's take a listen to what she had to say.
From our perspective, we are bottoming, I would say. It's hard to ever know if you've actually hit the bottom until you're past it. But what we look at is that it feels to us that there's bad news coming, but it's mostly kind of the aftermath of the shipwreck that already happened. And when you see some of the building blocks of recovery coming into place, it feels like we're probably at the bottom.
Kind of rate sensitive, though, isn't it? Like if ever there was a sector that has a huge rate sensitivity to it, it is what is happening with the property space right now. And that takes us back to this idea, are we going to see a two-speed story evolving? Are we going to see the Fed, for instance, staying on hold for much, much longer? European central banks, and today we're talking about the Bank of England a great deal, but others as well, maybe looking at cuts. And does that change the way you think about equities, US versus Europe? Well, let's try and get an answer to that question. Fabiana Fedeli, CIO for Equities, Multi-Assets and Sustainability at M&G Investments, joins us now on set. Great to see you. So,
good morning.
We're starting to get European central banks cutting rates. Yesterday it was the Riksbank. Today we could get some significant hints from the Bank of England that it's getting ready to pull the trigger and deliver a series of rate cuts coming through. Is this a reason to buy European equities?
That would not be the only reason to buy European equities. What you're seeing happening in the market, earnings actually are quite okay, particularly versus expectations, and valuations are undemanding compared to other markets in the world, i.e. the U.S.
Yep.
That is the reason to buy European equities. Not everywhere, you still have to be very selective, but there are a lot of interesting names out there.
In terms of how easy it is to make that decision, it used to be quite tough, and you had to be very selective if you wanted to get it right. Is it broadening out? Is it becoming an easier decision to buy Europe? You don't have to be as perfect in your decision making as you once were. Maybe you can think about buying broader baskets. Is that how it's evolving?
Well, you're asking an active manager, so possibly my answer will be...
Is your job getting easier, is the question I'm asking, therefore?
My job is never getting easier. I would say if interest rates come down, obviously some companies that have like bigger balance sheets, more complex balance sheets will have an easier life, but we're not there yet. Interest rates will probably come down, most likely, but will probably stay also sticky for a while. So the job is not easier. But what you're seeing in the current earnings seasons, what we saw already in last earnings seasons, which is some companies are doing far better than others, for example, because they're investing more in product innovation. So there is still a lot of selection to be done, but there is a lot of opportunity.
Fabiana, you make the point in your notes that actually if you look at the World Index, MSCI World Index, 6 of the 10 best performers year to date are non-US stocks, and actually those US ones that are in there are utilities, industrial, only one technology, US technology name in the top 10. Have we been slow in the sort of commentary universe? Have we been slow to catch up with a broadening trend that from that dynamic appears to already be in train?
I'm happy you pointed that out. Yes, the trend is broadening. Last year, if you would have seen the same ranking, you would have had pretty much all tech stocks, whether in the US. In the US, it was Nvidia and Meta last year. And then China, Asia, it was really a tech fest. Now we are broadening out. Investors are looking at other areas. I mean, utilities, for example, is coming to the fore, is one of the areas where investors are starting to find a lot of value. And also they're broadening out outside of the US, which I think is a very welcome change.
And so one of the things that stood out to me also is that there's a few China names in there and Hong Kong. Gradually we're hearing more positive things about China. Not that there's been necessarily one big catalyst for that, but various people pointing to stars aligning and the like, and feeling more favourable towards Chinese stocks. Are you also of that view?
So if you remember, the very beginning of the year, we actually increased our exposure to China. And that was on the grounds of some improving in the macro numbers and the government being a little bit more supportive of the economy. But at the same time, valuations were at oversold levels. Now, you still have to be selective in China. Not everything is going to be rosy. But again, there. There are a lot of companies that are exposed to global trends that are very strong, very competitive, and are now returning also cash to shareholders, which wasn't the case in the past.
So you're being selective in China, and you're following that international exposure story. Do you follow the domestic policy as well? Do you align with the policy when it comes to investing in individual names? And are you buying A shares, H shares, or European companies with that China exposure?
So there is now a lot of value in domestic companies listed on the H share market, but also on A shares. We buy both. You do have to always take into account the domestic policy. It is very important what happens there. You have to understand where the interests of the government lie. But again, often you can still find some very interesting stories where your interests are aligned with the government, for example, in the improvement of the overall economy.
Okay, and often, of course, when it comes to following the policy in China, you end up hitting against the geopolitical risk because that policy sometimes collides with what's happening out of the US. When it comes to that view, just looping back to what you were describing to Guy earlier, in terms of your relatively constructive view on European stocks, with the caveats and the need to pick stocks and maybe not buy the index, are you funding that by reducing holdings in the US, given that extended valuation you see, or do you hold? How are you thinking about the US component within the mix then?
So we are now underweight the U.S. versus international markets. We talked about China, we talked about Japan in the past.
What do you need to see to move from underweight U.S.?
Well, right now we just see valuations in the U.S. far too demanding compared to other markets for what the fundamentals are. So I don't think it's the time to move back to the U.S. But one of the things that we're doing, because you're seeing some very outsized reactions to market expectations at the moment with the earnings season. So you have companies who are actually having decent earnings, but because those expectations are so exaggerated, you actually see a negative reaction to the price. And those are companies where we find more value, and we will rotate into them.
Why are we getting such big swings on earnings? Massive 10%, like 7, 8, 9, 10% on a daily basis on mega cap names. You must be playing havoc with your portfolios, but I'm curious to know kind of why you think that is happening and what signal that delivers about what the market thinks about what's
So first and foremost, I'd like to see that as an opportunity for an active investor. But this has been a trend that we've seen for some time. Maybe it's easier for retail investors to get into the market. Maybe they like those big brand names. You know, it's easier with ETFs. They really pile into larger names. That is creating more volatility, but again, also opportunity.
We're going to talk in the next part of the program, Fabiana, about the M&A that we're seeing in the Spanish banking sector. Is this growing into something, capital markets theme? Is it investable in some way? Is M&A as a theme investable?
Well, you always have to see why the M&A is happening. If it's happening because a company is undervalued and has very strong fundamentals, then yes, it is definitely an investable theme. And that brings me to the UK market, where we've seen like a lot of bids coming, actually not from private equity, but from trade, which really shows that this market is undervalued and has a lot of potential.
Even at new highs?
Even at new highs, there are still, from a relative valuation standpoint, it's still relatively inexpensive.
Okay, Fabiana, thank you very much. Thanks for joining us. Fabiana Fedeli, CIO for Equities, Multi-Asset and Sustainability at M&G Investments.
Let's take a look at some of the biggest stocks in Europe. How are they performing? This is what the core six look like around Europe. These are the ones you want to be checking every morning to give you a kind of litmus test on what is happening with the market. Interesting that the defensive angle is to the forefront this morning. Nestle up by 2.21%, though I have a very strange feeling that the Swiss market might be closed today. Probably need to check that. There's a bunch of European markets. I wonder whether that's yesterday's price. Schneider, ASML, both a touch higher. Ferrari and LVMH on the luxury side, a little bit lower. I've also got a wondering feeling whether or not Denmark might be closed.
Switzerland is closed and Denmark is closed. So we'll revise that board.
Yeah. Probably should have thought about that one in advance. Anyway, let's talk about some stocks that are moving. Joe, over to you.
One market that is well and truly open is the Spanish market. Banco Sabadell getting a 5% gain today. BBVA coming down around 6%. Now BBVA doing this hostile bid, going directly to the shareholders of Sabadell, saying we want to buy that stock. Sabadell spokesperson reiterating to Bloomberg a few moments ago that they did reject that deal, but nonetheless it is a hostile situation. We're seeing those movements. The offer is around 2.1 euros, so we're trading below that, but potentially we might creep higher on Sabadell. Watches of Switzerland is buying a small Italian jeweller, according to a statement just a few moments ago. I believe that is yesterday's price, I'm being told at the moment, so we're still waiting for an open, so potentially we might see some movement in that one when it does finally open. Then we got John Wood Group earnings out today, but a massive jump out of the oil engineer yesterday. They've got a takeover bid as well. The latest UK company to get a bid is John Wood, the oil engineering firm, so trimming some of those declines, actually up 0.7% at the moment. Then in terms of your earnings, we mentioned a couple. We have got Telefonica. The rate of mobile tariff increase is declining. That's good news for all of us. They're way too expensive, aren't they? But then we've got ITV up 2%. Now, it used to be all about Love Island. Apparently now it's all about Hell's Kitchen. Gordon Ramsay boosting their studio revenue, according to the company today, and ITV getting a decent gain, up 2%. In terms of another energy one, we've got Harbour Energy. This is the best performer in the UK this morning. It's the North Sea oil firm. Some strong numbers out of that one this morning. But Argenx over in Belgium, they make a muscular drug, and they have got some weak earnings out today. So Argenx actually the worst performer on the stock 600 that's had a good run recently, but it's coming down at the moment. We'll take a look at a couple of the chip stocks. ARM, we're still gutted that they went to the US for that listing. They had earnings last night and they fell around 10%, so the grass isn't always greener maybe. The stock was down sharply, but we are actually seeing European chip makers gaining a bit, potentially more focus on the broader market. Chinese shares up overnight, and BE Semi down the bottom here. They've got a new order, a big order broke on the terminal earlier, but Infineon, ST Micro, ASML all higher. In terms of your UK home builders, the RICS data showed a decline in month-on-month prices. The year-on-year prices, though, were pretty steady, and the market probably looking ahead to that BOE decision at 12, so focuses on that, focuses on bond yields. Finally, one morning call just broken on the terminal. Deutsche Bank is a new buy on Barclays this morning. Now, this one's had a good rally given the buybacks that they announced just a couple of weeks ago in their earnings, but Deutsche Bank still sees upside, and they go to buy on that one, and Barclays gaining 1% in London this morning.
Joe Easton from Mercury Team, thank you very much indeed, with the Love Island fandom as well. Joe, thank you. Coming up, we're going to be talking, of course, about what's happening with BBVA, coming through with that hostile offer then for Sabadell, and both stocks, of course, moving in vice directions on the back of that news. We'll be talking about the future of Spanish banking and what this potential takeover signals. That is next. This is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I continue to think that it's over time is going to be is necessary to see more consolidation in the European banking. We may be seen as a playbook or a reference point going forward on how to merge two larger banks, but eventually what we've seen right now in Spain at least is a scenario in which you go through first mainly domestic consolidation, and this is a prerequisite later on maybe to expand this into a more European framework. Now, in order to do that, you need to have a banking union model.
Well, that was Sergio Amotti, of course, the CEO of UBS, speaking about potential consolidation in the banking space. Are we taking a step in that direction then? BBVA jousting with Sabadell over the last few days. The latest lines coming through this morning then, launching this hostile all-share tender offer for Sabadell. And, of course, you're getting pretty marked moves in the stocks. Unsurprisingly, on the back of this, Sabadell up around 5% and BBVA taking a bit of a knock on its stock price, down 5.5%. For the details then in the jousting that's been going on between these two banks, and again, it could end up being the second largest bank alongside Santander in Spain if it goes through. Let's bring in Tom Metcalf from our banking and finance team. Tom, why then did BBVA go hostile ultimately?
Yeah, I mean, this is a very rare move. I think the last hostile bid in Spain was in the late 1980s, so, decades ago. I think it's probably a reflection of just sort of how sour the relationships are now between these banks. The news of the deal broke, so they had to sort of move a bit quickly. But it does seem that, both sides are almost talking past each other. So Sabadell, perhaps might be open if there was an improved offer. Instead, BBVA have gone straight over the board to its shareholders with effectively exactly the same offer that the board rejected.
There's a headline crossing which I'm a bit confused about, so just maybe we'll get... So Spain opposes BBVA's hostile bid for Sabadell. That's according to a spokesperson. A spokesperson for who? Spain?
Yes.
I guess in the regulators.
This is... yeah. Why would the government, the regulator, be opposed to this?
Yeah, I think it's because hostile bids are so unusual and obviously just bring extra trouble. Everyone knows a big bank M&A deal is extremely complicated, so you really want both sides pulling together. So, effectively with the Sabadell board rejecting this, BBVA, have to go this alone almost. And that's why it just injects that extra uncertainty. And I think from a regulatory point of view, they're like, wow, if the board don't want this, then do we really want to be injecting that into our banking system?
So the hostility involved here adds some extra tension, maybe some execution risk, because the share price is certainly trading well below what is suggested to be the offer price by BBVA. What are next steps then here, Tom? I mean, this then is in the hands of a quite international shareholder base, actually. I was looking at the sort of own function on the Bloomberg. Only 7% of Sabadell shares held in Spain, and lots around the rest of Europe. So now the international shareholder base has to decide what it wants to see here.
Yeah, exactly. 50.1% of them have to accept this offer for it to go ahead. Otherwise, it's void. I think there's some analysts out there still saying, hey, maybe the sides can start talking again. To be honest, the way this has gone down, I'll be slightly sceptical of that right at the moment. But that's probably the only way I see a sort of resolution to this. We've just seen that headline that, if the Spanish government are not keen on a hostile bid, I don't see any way this sort of goes through as a hostile bid, at least.
OK. Tom, outlining some of the challenges there. Tom, in terms of your view, take a kind of broader look at this. Is there a rational need for consolidation in Spain? And does this signal that, or are we overreading it? Does this signal potentially that we're at the cusp of some pickup in consolidation more broadly in the European banking space?
I'll echo what we just heard from Amotti. I mean, there has been consolidation in Spain, but there's more to come. It's come down from like 50, 60 banks to, 10 or so. But the sense is, for a banking system to work, you really need a handful of giants like you see in the US and to a lesser extent the UK. I think there is definitely a very good case for domestic consolidation. That big question of cross-border consolidation that we all want as journalists is the most exciting story, is probably still, that is regulatory dependent. And, you see the trouble today with a domestic bank deal. Gosh, imagine how much more complicated that is.
Well, that's the issue here, isn't it? And almost if the banks are still looking domestically, doesn't that imply that they still seem to signal that doing cross-border deals is completely off the table? If you'd rather go for a really complicated deal between two Spanish banks that is going to be hard to pursue, rather than going, are there better options around Europe? Doesn't that just tell you how hard potentially cross-border deals still are as perceived as being?
No, that's absolutely right. Much harder than a domestic deal. As hard as the BBVA-Sabadell connection looks like, it actually would be a hell of a lot easier than pretty much any kind of cross-border deal that could be feasible.
So, I mean, in terms of that the banking consolidation story, we still wait, we watch, and we see if we get any news. Tom, thank you very much. Bloomberg's Tom Metcalf joining us there with the latest on the banking sector. Coming up on the programme, our exclusive conversation with the Google DeepMind CEO and co-founder Demis Hassabis. Also earlier this week, we heard from the head of the Global Vaccine Alliance, that's Gavi, on the possibilities of AI in the health sector moving forward.
AI can fold months of work into seconds, literally. We've got country focal persons, and people are really overwhelmed with work. And I think some of these some of what the LLM modules can offer, which are very basic, even open source, can be transformative for the way we execute at the last mile. I think it's a question of institutionalizing them, having a different mindset. I mean, we as an entity have to be constantly prepared for a next outbreak, for a next pandemic. The reference point is that if there's another pandemic, we should be able to just switch on the light of a control room and take our seats and operate.
Sanya Nishtar, the CEO of Gavi, the Vaccine Alliance. And Tom, this opens up very nicely into our next conversation we're going to have after the break, which is the role of AI in healthcare. She's talking about last mile delivery of vaccines and how AI can make a job that usually takes months. It can allow it to be done in just minutes, which is quite incredible.
And if you can shorten the time around R&D, then that will be consequential as well. And that's where the likes of DeepMind, Google DeepMind, hope they can play a really significant role, particularly with the upgrade to this software system, this AI software system called AlphaFold 3. So we spoke exclusively to Demis Hassabis about this. And in fact, what they're able to do now is predict the way that different proteins interact with things like RNA. So, of course, when we think of COVID vaccines, we think of mRNA. So that could be really consequential in terms of vaccines, but more broadly as well in terms of healthcare.
This conversation then continues after the break. We're going to play you a substantial part of Tom's interview with the Google DeepMind CEO and co-founder Demis Hassabis. We'll bring that conversation to you. Really exciting to carry on these conversations then about AI and health. That's coming up. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more I would say volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back. This is Markets Today. 30 minutes into our European trading session. We are pretty flat on these markets, down 0.1% on the Stoxx 600. The CAC 40 is entirely flat. The German market making modest gains. The IBEX is under pressure, down by just over 1%. A lot of that has, of course, to do with the Spanish banking sector and the M&A story and the hostility around that developing there. The FTSE is pretty flat, so we're going nowhere in a hurry, seems to be the summary.
It felt like it yesterday. Yesterday was definitely a session in need of a catalyst, but actually equity markets
did okay.
Powered higher in the absence of anything kind of obvious, but earnings were the apparent catalyst. Today, I'm not even sure we have the earnings story really to kind of get us going.
The AI story didn't come through either in terms of ARM. So there's a lot of expectations, and the earnings weren't that bad. But again, it talks to that expectations story.
US earnings actually were quite weak yesterday.
Yes,
that was the narrative that we got. So ARM didn't look particularly good as well. Airbnb, massive reaction. That feels like a sort of seasonality factor, but I think expectation had got pretty high around Airbnb. So there was some weakness there as well. So the US earnings season didn't look good. The European earnings looks much better yesterday. Stocks like Puma doing really well, powering the market a little bit higher. But today, I'm not even sure I've got that. I've got a lot of ex-dividends. I've got a lot of markets closed. We need a Bank of England maybe is going to be the catalyst. I don't know.
Screaming out for that catalyst, the BOE or the inflation data out of the US. But yeah, it does look like we're looking for that.
We've got a lot of days. We've got a lot of hours of programming.
We've got Friday to get through,
Do not be despondent, though, because we can go back to the AI conversation. So I had this exclusive, we touched on this, we've teased it, which is great. We had this exclusive conversation with Demis Hassabis from Google DeepMind, the co-founder, the CEO. By the way, all of the AI components within Alphabet now report up to Demis. So he's taken on this additional power. He is essentially Alphabet's AI chief right now as well. But we had this exclusive conversation because they've launched this new software platform. They had something called AlphaFold, which could predict protein structures. They've come out with something called AlphaFold 3, which can predict not just protein structures, but how they interact with other molecules like RNA and DNA. The consequences could be really significant. Take a listen to what Demis Hassabis had to say about some of these changes, and more broadly as well, his views on how AI and generative AI is evolving.
Of course, biology is, as we know, is a dynamic system. Really, all the emergent properties of biology and life are due to interactions between different molecules and different structures. So that's what AlphaFold 3 is about, is a first step in that direction, understanding this dynamic picture and understanding what proteins interact with and how they interact with those other types of molecules. So not just other proteins, but also DNA and RNA, like you said.
And for the medical world, and in terms of drug discovery, how significant do you think this could be in the months and years ahead?
Well, of course, the holy grail for drug discovery is not just knowing the protein structure, which is what AlphaFold 2 did, but actually designing drug compounds called ligands that bind to the protein surface. And you want to know where it binds and how strongly it binds in order for you to design the right kind of drug compound. So AlphaFold 3 is a big step in that direction of predicting protein ligand binding and how that interaction will work.
Given the technology you now have at your fingertips and everything you know about how this is progressing, what is your best guess as to what will be the first AI-derived and discovered drug?
Yeah. Well, we announced earlier on this year some big partnerships with Eli Lilly and Novartis. So we're already working on real drug programs. And I would be expecting maybe in the next couple of years, the first AI sort of designed drugs in the clinic.
That's really interesting. In the next couple of years, Isomorphic Labs, look, I know this is a passion of yours. You oversee this unit. It's a separate business, but under the Alphabet family, of course. Yeah. And it's that generative AI or AI-developed drugs. And you have those partnerships, as you say, Novartis, I should say, and Eli Lilly. Up to $3 billion of revenue. Does AlphaFold 3 get you closer to unlocking that revenue with those commercial partners?
Yeah, it's a critical part of the tools that we have at Isomorphic. We also have some other AI systems that fill out this space of drug discovery. There's a lot of different techniques and modules that are needed in order to cover the whole of that very difficult process. AlphaFold 2 and the protein structure was just one small component of that. And you can think of Isomorphic building many tools that fill that out, moving more into things like biochemistry and chemistry so that we can design the right drug compounds.
And you've talked about being in a low data regime. And when we think about what's needed for generative AI, huge amounts of data, of course, and for some, not all, but for some copyrighted data, but also huge amounts of energy, electricity, water, and huge amounts of cash. Are the foundations of generative AI challenged when it comes to the sustainability of this?
I think that the benefits that the generative AI models that we build, things like drug discovery and other stuff, that is going to far outweigh these costs, I think, in the long run. So including even on things like energy and climate, where I think AI has a huge potential to help with that, derive more efficiency from our power grids, inventing new materials, new technologies, clean technologies, things like helping with fusion. I think that AI can be applied to many, many of these areas and be extraordinarily productive and helpful in all these areas and far outweigh the costs and efforts that are involved in building these models.
So it can be sustainable, and you don't see these as major roadblocks. I mean, particularly the energy component and the shortage of data now.
Well, look, there's challenges. There's always is in research, and we've got to be innovative to figure out our ways around that and how to do that. You know, for example, the data question. There's lots of interesting work going on with things like synthetic data and how to generate self-generate data, and we're actually experts in that from the past with our gaming work, where if you take our programs like AlphaGo, that was self-learning, self-improving through playing against itself. So in effect, it was generating its own data, and I think some of those kinds of techniques can be transferred over to the new world of generative models and large language models.
Broadly across what's happening with generative AI, the critics, the skeptics say, look, there's a lot of hype involved, and we have seen companies like Stability AI, they've been challenged with their finances. The likes of Inflection being absorbed by Microsoft. Are we at a point now where we're seeing a little bit more rationalization, where we should look to maybe see more closures, more failures, more acquisitions?
I think, funnily enough, in many ways, I think AI is overhyped in the short term and probably underestimated over the long term, like what it's going to bring. And I think that's probably true of a lot of breakthrough technologies. So I think we're seeing, because of the popularity of AI now in the last couple of years, lots of people trying to get into this space who maybe haven't thought about this as long as people like us who've been in it for decades. And I think we're going to see a sort of rationalization process happening. But I actually think what it's going to end up delivering is going to be even beyond what the most optimistic end of things that we can see are in the near term. But in the longer term, I think there's going to be enormous benefits and enormous opportunities. But as with any new market and new technology, there'll be a lot of twists and turns on the way there.
As we look to the end of the year, so much changes within this space, so much evolution, so much innovation. What are the kind of changes, what are the big things that you think are going to come about between now and the end of this year that you've got on your radar?
Well, look, I think there are huge things in the science space. You know, I'm very excited about what isomorphic's doing and what AlphaFold 3 can do with drug discovery. I'm also really excited about the next stage of these large general models. You know, I think the next things we're going to see, perhaps this year, perhaps next year, is more agent-like behavior. So systems that are able not only to just, you know, answer questions for you, but actually plan and act in the world and solve goals. You know, and I think those are the things that will make these systems sort of the next level of usefulness in terms of being a useful everyday assistant. For example.
So those AI agents are maybe 1 to 2 years away in terms of having that utility.
Yeah, I mean, we're working hard on that. Others are too. And again, that's bringing back in some of our work we did years ago with gaming, which were all agent systems, you know, achieving certain goals and objectives, bringing that kind of work and marrying that together with the modern, large, multimodal model work.
Bring it back to isomorphic labs, because this is where a lot of this started in terms of drug discovery and the conversation there. Are you under pressure when it comes to isomorphic labs to commercialize these products? What is the potential revenue stream of that unit?
Well, I think first and foremost, we you know, I think it's the most beneficial thing. If you ask me the number one thing AI can do for humanity, it will be to solve, you know, hundreds of terrible diseases. You know, I can't imagine a better use case for AI. So that's partly the motivation, you know, behind isomorphic and AlphaFold and all the work we do in science is to advance society and benefit society in these big ways. But I also think that if you could revolutionize drug discovery process, make it 10x faster and more efficient and more likely to pass through the clinical trials because you can predict the properties better, that has to also be enormously of an enormous commercial value too. So I hope to do both with isomorphic, you know, build a multi, you know, $100 billion business. I think it has that potential as well as be incredibly beneficial for society and humanity.
Okay, Google DeepMind co-founder Demis Hassabis there on AI software breakthroughs in bioresearch and what it could mean for the pharmaceutical industry, on which we bring in, of course, our expert Sam Fazeli in-house from Bloomberg Intelligence on what this actually could mean in terms of AI-developed and AI-generated drugs. Sam, given what you've heard from Demis Hassabis there, he thinks, and this is what really surprised me, was the time frame he gave when I asked him, when do you think the first AI-developed drug will come through? And he said 1 to 2 years. And then he said isomorphic labs, which sits under the Alphabet family, which is specifically focused on that job, could be worth in the hundreds of billions of US dollars. Is that time frame, let's start there, is the time frame realistic, Sam?
Well, so first of all, I have to say you've just talked to one of the luminaries in the space. So, you know, he is absolutely on top of everything that you've just been talking about. The reality is slightly different, though, because any drug that's discovered by any method, be it an AI system or a human neural network, let's put it that way, but of course they can scale much more than putting 5,000 humans doing the same job, is going to have to go through the rigor of testing, preclinical testing, and getting to the clinical trials, which can take anything from 5 to 10 years, depending on what sort of disease you're trying to treat. If you're cancer, you haven't got another choice, you go early, you treat a whole smaller group of people, you can get through quicker. So a lot of it depends on that. He did say something very important, of course, that if the AI system is able to identify drugs that have less risk of failure, so that when you put them in the mice or in the monkeys or in whatever model you have to do before you're allowed to put it into humans, and there's no untoward effect, faster and more likelihood of getting through it, then you increase your probability of success. If you go into the first human, usually healthy volunteers, and nothing happens, and you go to the patients, that's where you've got the win. That's where a lot of drugs keep failing. And of course, your prediction of whether it's going to work or not is another element.
This is all predictive, and this is modeling. How much does the system not understand about cell biology, cell chemistry? And when it doesn't understand something, how does it deal with? Because in theory, you could just design entire drugs, test them on humans, all within the computer. But I'm assuming that there are bits that we don't know, which is why we're going to continue to test on humans.
You mean the famous unknown unknowns?
Yeah, we're going to get Rumsfeld about it.
Yeah.
Yes.
Now, so there's two. I would answer that in two ways. One is, if you don't know, you just don't know. If there's no biology deciphered on it, you won't know.
But there must be structures within the cell that the system cannot understand.
If no one's ever looked at them, although it has got predictive capability, which is, I think, what's fascinating here.
Sure.
What is more interesting for me is that there is such a massive body of science. If I showed you how many papers are published on a single day from scientists across the world sharing their information and data, and how you synthesize that information, and people like you and I have biases. Hopefully the AI system doesn't have biases. I'm an immunologist. I'm going to keep looking at stuff related to immunology. What if there's an important piece of information that came out of some genomics somewhere that I haven't connected with because it's not my forte? The machine doesn't care about that. It looks at the information and tries to find missing links and putting links together. That's where I think the real power of this is, in that massive data analysis.
Okay, so in drug development, clearly some really exciting opportunities ahead. Sam, I was speaking earlier this week, and we played a clip of it earlier, to the CEO of Gavi, and this is all about vaccine distribution and the Vaccine Alliance, and she was talking to us about last mile distribution and how AI could play a really important role there. She was saying that you can take jobs that previously would take months to work out how you do that last mile distribution of those vaccines, and you can do it in seconds using actually AI technologies that already exist. So in some parts of the world, AI and health can already be coming together. This isn't something that takes 2 years. This is something that might deliver real results soon.
Absolutely. I mean, if you want to take it much broader than drug discovery, every aspect of the pharmaceutical product development chain, from going into clinical trials, writing applications to the FDA, and organizing clinical trials, running them, capturing the data, analyzing it fast and real time. Every single one of them. Then supply chain, manufacturing, everything can be touched by that.
Sam, across the pharmaceutical companies that you look at, how seriously are they taking this AI question? To what extent are they embedding it into their systems? To what extent is DeepMind and companies like Alphabet a threat or a partner to them?
I think to answer your last question first, they are not a threat. These guys, pharma companies, are all over anyone who can give them a new drug. And if that looks like, M&A, licensing, whatever. So, which is what already Isomorphic has done. A couple of deals. Yes. He mentioned Novartis and I think Eli Lilly. Yeah. So that's not a problem. They love that. The question is, inside, how are they applying this? I don't think there's a single pharma company that isn't or hasn't looked at this. And let's not forget, it's not just about AI. It's about machine learning. It's about just being able to have good digital systems where people can talk to each other, for example. One of our successes is obviously the Bloomberg chat. And so, those kind of systems within pharma companies, allowing the analysis of data as soon as it appears in one place in Raleigh, New Jersey, being accessible to people based in Stevenage, for instance, those are already happening.
Raleigh, New Jersey and Stevenage. It's not a connection you want.
Those are the two hotbeds of, I think, pharma companies.
Excellent.
Or near Stevenage.
Okay. Yeah. In the environs of Stevenage. Sam, great stuff. Thank you very much indeed. Sam Fazeli from Bloomberg Intelligence. This is the good stuff from AI.
The good AI stories.
The good AI. It's going to benefit us all. We're going to get drugs much more quickly. They're going to be much better. We're going to save humankind. Creativity. Apple has got a bit of a problem. This new advert that they've put out for the new iPad, which has these super fast chips, the idea is, I think the idea is that it's basically is going to do all these things like pianos and paintbrushes. Oh. But everybody's falling out with this advert.
I don't mind them crushing the metronome, but everything else in this video upsets me.
So it's crushing creativity, basically. And this is, so a lot of people have really kicked up a stink about this. This looks like a significant own goal for Apple. You're crushing
guitars.
All of the great things that we as humans create.
Absolutely. All that culture, all that creativity crushed there, replaced by a bit of tech. And that's the point. It does tap into our fears. There's the hope around AI and around healthcare. That could be incredible, as Sam has suggested. But there is also the crushing sense that creativity is under threat. I mean, I played plenty of music growing up, and keep music live was always a mantra back then, and this was decades ago. It means even more now.
Yeah, Tim Cook posting this apparently on his own X account on one of the social media channels, and as you say, facing a lot of pushback.
It's really badly.
Yeah, the creative industries are already freaking out about this, and we saw that with the writers' strike, didn't we, in the US, and the fact that they encoded it in their deal with the big Hollywood studios.
Absolutely. But Apple's always been perceived as being the friend of the creative.
Yeah.
Yes.
This has been, we have generated tools that will allow you to be
more creative
yeah. and do better things, and it's going to augment rather than hurt what you do. It'd be really interesting to see how they deal with this. Apple is facing challenges on multiple fronts at the moment.
Multiple challenges. And talking about tech, we're going to be speaking later to ARM's chief executive, Rene Haas. He'll be speaking, in fact, with colleagues Ed Ludlow and Caroline Hyde over in the United States. That's at 4 London time. That's part of Bloomberg Technology, an event taking place in San Francisco, bringing together leading CEOs, tech visionaries and industry icons. We'll be coming back to you with the latest on the BOE. Will it deliver a boost to British households? That's next. This is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
This is Markets Today. We are 51 minutes into a European equity session that shows some outperformance in London, some underperformance in Madrid. We'll get to the Madrid story shortly. Let's focus in on the macro themes here in the UK. Bank of England Day, of course. Will Governor Andrew Bailey deliver a lift to British consumers with a stronger signal on when borrowing costs might be cut from their 16-year high? Let's ask Lizzie Burden. Bloomberg's Lizzie Burden joins us on set right now as we run up to the Bank of England. Lizzie, good morning once again. So what clues are we looking for then in terms of this dovish messaging from the Bank of England? There's a danger we don't get that and they just say it's all about the data, but what are you looking for?
Of course they'll tell us that they're data dependent. When don't they tell us that they're data dependent at these central bank meetings recently? But in terms of the clues as to the path beyond that first cut, look at the guidance. Does the wording change? Do they say that cuts are coming in the coming months? Or even do they just say, look at certain data points and use that as a hint to whether it's going to be June or August? That's been the ECB's approach. Then listen to the press conference as well, any clues from Andrew Bailey. Look at the vote split. Does Deputy Governor Dave Ramsden join Swati Dhingra in voting to cut today? And look at the forecast as well. Do they actually reduce where they see inflation in the future beneath the 2% target to push back against the market curve and say actually it's too cautious right now?
What kind of reaction do they want from the markets? The Bank of England has struggled to communicate with the market and not get big reactions. Do they want a little reaction today? Do they need to see a significant repricing? What do you think the bank is anticipating from its messaging?
You would think, ideally, they'd want to communicate the dovish tilt that we've heard in recent speeches, but not go too far in that direction. They don't want an overreaction in the markets. In the markets currently, it's cautious, the mood. At the moment, they're fully pricing an August cut. June is only about 40% priced. If they're going to go in June, they want to have bond traders adding to that bet, right? This is the last opportunity to lay the groundwork for June with a press conference. I think it's interesting, you could see weakness in sterling, a boost to gilts if you have this dovish tilt in the forecast, etc. But it seems to have been a bit overplayed in the case of the Bank of England, that if you have that currency weakness, it would refuel inflation in Europe. Because, first of all, Andrew Bailey's already said that the ECB and the Bank of England are more similar in the inflation that they're tackling than the Bank of England and the Fed. But also, when you think about how much trade the UK does with Europe, it's much bigger than with the US. So it's the pound-euro relationship that matters more so than cable to the inflation story.
Okay, Bloomberg's Lizzie Burden breaking down what to look for then, and in terms of the potential market impact. As we look at the pound, a little weaker so far in the session at 124, down 0.2% versus the US dollar, not the euro right now. The gilt 10-year currently a little bit mover in terms of yields up 3 basis points, 4.17 on the 10-year. So a little bit of selling pressure coming through. Yields up 3 to 4 basis points. The Bank of England's decision, of course, coming at 12 p.m. London time. We're going to have special coverage, of course, of that and the press conference for viewers here in the UK. Will also be streamed on our Bloomberg TV YouTube channel as well. And we're going to have analysis and commentary on the terminal at T Live Go. Later today, we're also going to bring you an interview with the BOE Governor, Andrew Bailey. So something to look out for as well, of course, what Andrew Bailey has to say, whether he reiterates the kind of dovish, at least inflation-sensitive lines that came through at the IMF, where, again, as Lizzie was saying, he suggested the inflation dynamics here in the UK are very different to those in the US.
And Bruna Skarica was picking up on that earlier, wasn't she, from Morgan Stanley? I liked her line, similar to Lizzie, making the same point as Lizzie about it being more Europe that matters than the US, saying don't treat us like a beta to the Fed, and that's maybe another message that we get from Bailey coming through today. Yeah,
I think if the Fed doesn't do anything this year, then I think you probably need to factor the Fed into your thinking. So I think it was Holtzman earlier today talking about the Fed being the gorilla in the room still. I don't think you could ignore the gorilla in the room. It's a very bad idea to ignore the gorilla in the room.
When we're talking about the rates environment, I wonder how it factors into the decision to go for a bid by BBVA, Sabadell. That story unfolding, of course, the rates environment becoming less benign, arguably, if rates come down for these banks. So the detail, of course, they've come through with this hostile bid. That was the big news story that crossed a couple of hours ago. BBVA coming through with a hostile bid, Sabadell, an all-share deal, and we see the reaction on the share price for both these banks then.
It's fascinating to see kind of the reaction. The market is clearly signalling that there is a greater possibility now they've gone hostile, but not a significant kind of probability that this deal is going to happen.
Yeah, because we're not trading anywhere near the offer price.
We're
187 is not over €2. And the Spanish government really pushing back against this. And if you look at the reasoning, they're saying it would negatively impact employment and financial services, potentially adding risk for financial stability. They call it excessive consolidation. So this isn't about the hostility, it's just about consolidation.
Well, I think I think the hostility would be really difficult. This is you have to take out so many costs in this business. To do it with an unfriendly counterparty would be quite difficult.
Excessive consolidation in a market with 10 banks of that size, as Tom Metcalf was outlining for us. That is it for markets today.
You can go. The Pulse is next. I'll go. The Pulse is next. Francine will be taking over. We're counting you down to the Bank of England. This is Bloomberg.
the tech
It's
sector.
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. It's BOE decision day. The Bank of England is expected to hold rates at a 16-year high, but will it signal when it will start lowering borrowing costs? President Biden warns he'll hold back more weapons if Israel invades Rafah. Plus, the Spanish government opposes BBVA's $12 billion hostile bid for smaller rival Sabadell. The combination would create a new Spanish banking giant. So let's take a look at the European markets map. We actually have a pretty busy day. We have jobless claims also in the U.S. We have Bank of England. And you can see the rally that we saw in the last couple of days really fade away a little bit. Now, Treasury is also slipping, so let's get to cross-asset. We had a weaker than expected bond sale in the U.S. Now, the recent stock bounce seems to be fading for a couple of reasons. First of all, we're at the end of the earnings season, and so a lot of the good news or encouraging news has already been priced in. And then maybe there's a bit of anxiousness amongst the traders. They want to move away from earnings, start pricing in what central banks will do. And again, while the BOE policymakers are not really expected to keep or are not really forecast or are forecast to keep rates on hold today, a lot of the focus will be on a dovish tilt going forward. You can see euro dollar at 107.34, and then we also need to look at pound Brent 84.20. So the Bank of England expected to keep interest rates on hold at 5.25% today. Governor Andrew Bailey may give a stronger signal on when the central bank can lower borrowing costs from their current 16-year high. So for a preview, we're delighted to be joined by Bloomberg's UK correspondent Lizzie Burden. So Lizzie, good morning. I know there's going to be possibly quite a lot of clues, we hope, or at least traders hope, from the governor about what happens next. But there's a lot of people who say, look, he was late actually to cut interest rates, and there's or to hike interest rates, and you know the other way around could also be a problem.
Yeah, it doesn't want to be behind the curve. You've already had the Riksbank, the SNB, in the pivot party, and the ECB very clearly telegraphing that they're likely to cut in June. So the focus today is on when that first cut comes and then the cuts after that. I'm sure this is going to dominate the press conference later. In terms of the clues for the market, first of all, look at the language around the decision in the guidance. Do they say that some cuts are coming in the coming months? Do they follow Christine Lagarde's lead and actually say these are the data points that we're watching as a signal of whether they're going to go in June or in August? Mind the vote split as well. Does Dave Ramsden join Swati Dingber in voting for a cut? He seems to have had a bit of dovish tilt recently. And then look at the forecast. Do they push back on inflation hitting the 2% target? Do they drop inflation in the forecast, given that it's predicated on the market curve? That would push against the caution in markets at the moment. But it's really going to be difficult for them to wait till August, Francine, if inflation is below the 2% target before then, when you've got all these other central banks on the cutting path already, and when you've got political pressure from the likes of Jeremy Hunt, who's said already that it would give a feel-good factor to voters when the cuts do come.
Yeah, the concern is, of course, it's not a trend actually with inflation going down. It kind of goes back down a bit and then a little bit up. Thank you so much, as ever, our UK correspondent there, Lizzie Burden. Now, for more on that BOE decision, let's bring in Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. Kim, so good to speak to you. Thank you so much for coming on. If you're a Bank of England governor right now, I mean, it's a little bit of a tightrope because you also have the elections coming, and so there's probably like a quiet period where you can't do much without it being seen as a political signal. What are you expecting to hear today?
So today, we think the forecasts are going to tilt dovish, the market path. But from the last forecast meeting, it's only pricing in 4 cuts now till the end of next year. That market path of the last meeting was showing 2.5 more cuts. So that's going to mechanically pull down the forecast. We think it's going to also show the market that it's now pricing in too little till the end of next year. As Lizzie said, we do think Ramsden's going to join Dingra for a vote to cut at this meeting. His latest speech told us that now he sees the balance of risk to disinflation or inflation to the downside. He also talked about the next print for the UK inflation number to really converge to Europe rather than the US. So I think that it makes sense for him to start voting for a cut. He has also voted differently from the internal members before. I think 3 times as Bailey's been at the head. So we think that's coming. But I think they're going to keep the door open to June or August. And there's a lot of more data to come before the June meeting.
So is there a danger actually that they act, too decisively? So actually that they cut by too much or that they cut too quickly?
Yeah, I think it's really down to the next 2 inflation prints before we get to the June meeting, because I think this month's a big month for the UK. We get all the annual price and wage resets going into the inflation and wage numbers. And last year, the Bank of England was really surprised on the upside to the extent of this dynamic. So they're going to keep the cards close to the chest. I think they should be patient, wait for that data, and don't give away too much at this meeting.
Again, in terms of timeline, and I know every central bank will push back and say, well, I'm just setting rates for my economy, but we're so global and there's so much interaction. Does that make a difference to interest rates and, to for example, gilts if they cut after the ECB or before the ECB?
I don't think those 2 months really make too much of a difference. I think the picture is slightly different to Europe. I think Europe's further down on that disinflation path. There's still a bit more uncertainty in the UK. But I do think the Bank of England can go before the Fed. I think the narrative has been challenged a lot more in the US than it has been in the UK. And I think there are more signs here that that policy is restrictive here.
Kim, the Fed, we also have jobless claims. The Fed expectations have kind of been all over the place. What's your baseline?
We think about 2 cuts this year. I think it's really important for the bond market that Powell really torched the idea of hikes. When he was asked for scenarios, he gave us 3, 2 involved cutting, 1 involved staying on hold, even if inflation stayed persistent. But we think the Fed's going to be slower than the bank and the ECB. Growth has come off after Q1, but it's still strong, much stronger in level terms than Europe. But we do think you're going to get this broad disinflation come through the year, just a little slower than the rest.
Are we importing disinflation or deflation from China? Or, again, what's the dynamic between the US and China right now?
Yeah, so I think China, we've seen a bit of a reacceleration in Q1 in growth, but it's not changing our overall narrative for the year. It's still government policy that's coming through to put that 5% floor rather than really try to boost the economy. There's still a lot of fragility there. So I think for us to believe in an acceleration from China and inflation from there, we're going to have to see something pretty different.
So, it's a complex world in terms of central banks. Is there anything that you'd be buying right now? We also had a bit of a weak, actually, treasury auction.
Yeah, I think, so UK is our favorite market. I think versus Europe and US at the moment, everything's coming into better balance, but I don't think that narrative's fully priced yet. So you've got the labour market loosening, you've got signs of inflation persistence weakening, fiscal's a little quieter. I don't think that's fully priced in the market. And we used to like Europe a lot. I think the challenge for Europe now, though, is that, as I said earlier, it's the furthest down that disinflation path. But the ECB has also dug its heels in for June. So it's already done that dovish pivot. The new news has been kind of a reacceleration in growth instead. So it's a well-positioned market, I think kind of lacking an immediate fundamental catalyst. So our expression there is more in the carry space rather than bonds.
Is there anything in European bonds that you like? Maybe play against each other?
Yeah, so from the carry perspective, we like. I think you got to be strategic between these and a bit tactical. But Spain, Italy, things like agencies. I think the news around the EU is really interesting. With it possibly going into benchmarks, that could be a big tailwind there. So carry in those kind of areas.
Kim, thank you so much. Kim Crawford there from JP Morgan Asset Management, of course, stays with us for a little bit more market insights later on in the program. Now, the Bank of England's decision comes at 12 p.m. London time, and then we'll have special coverage of that at the press conference for viewers in the UK. Everyone else can also watch it streaming on our Bloomberg TV YouTube channel, and we'll have analysis and commentary on the terminal at TLive Go. Now, later today, we'll also bring you our interview with the BOE Governor, Andrew Bailey. A couple of corporate news we need to tell you about. ARM shares have fallen pre-market after the chip designer gave a lukewarm revenue forecast for the fiscal year. That's raising concerns that the tech industry's artificial intelligence spending spree is slowing. And then later, the chief executive of ARM, Rene Haas, will also speak to Ed Ludlow and Caroline Hyde in the U.S. Catch that interview on Bloomberg Technology. That's at 4 p.m. UK time. Airbnb shares also falling pre-market after the home rental company's second quarter revenue forecast trailed the average analyst estimate. Now, Airbnb provided lackluster guidance for a second consecutive quarter, indicating that growth in travel spending will actually slow further before the peak summer season kicks in. Now, coming up, President Biden says he'll halt additional shipments of offensive weapons to Israel if it proceeds with a ground invasion of Rafah. That's next, and this is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
So President Biden says he will halt additional shipments of offensive weapons to Israel if it goes ahead with a ground invasion of Rafah. Now, he said the potential loss of civilian life is, quote, just wrong. For more on this, I'm joined by Bloomberg's EMEA News Director, Roz Matheson. Roz, thank you for joining us. So what has been, the response from Israel to the halting of shipment?
Well, we haven't had any official response from the Israeli Prime Minister Benjamin Netanyahu to this comment, but we know, of course, that Israel is quite upset about it. And certainly some of his ministers have been coming out to say that regardless of this move by the US to stop this shipment of bombs to Israel, that Israel needs to go ahead as planned with an offensive potentially in Rafah certainly needs to go ahead with its war against Hamas and go ahead with its ultimate goal, which is to eradicate Hamas as much as they can after the attack by Hamas on Israel back in October. So very much strong messaging from some of the ministers. We've had a couple, particularly on the far right, coming out to say that Israel should really respond to the US on this. But we are seeing caution from the Prime Minister about taking on Biden directly over it. Either way, it certainly has not landed very well in Israel itself.
So, Roz, what other weapon shipments the U.S. could actually potentially stop?
Well, they're talking about offensive weapons primarily, so anything they don't want to be sent to Israel and then used in the war in Gaza, particularly in Rafah, and they don't want those to be used particularly against civilians. So it's bombs, it's modifications to bombs to make them more targeted, more guided, anything of that nature. They're not talking about defensive weapons, if there's such a thing, basically what Israel would be using to defend itself, particularly, again, the Iron Dome missile shield or artillery and ammunition for Israel to use against Hamas. But they don't want any of the heavy equipment that might be going across into Rafah, and that's bombs and modifications to bombs. They're called tail kit, and that adjusts a bomb to make it more targeted. And some of those are on the runway, so to speak, for the US to send to Israel, and some of those shipments might not come into doubt.
But so, Roz, does this actually really change anything for Israel and this potential offensive?
It doesn't change the potential for an offensive. It might slightly change the nature of the offensive if Israel has less heavy weapons to use in that offensive, but certainly doesn't change the trajectory of the thinking really for now for Israel. They might slow down a bit because they do want those weapons ideally in an offensive, but it doesn't slow down the intent, which is to go into Rafah at some point and certainly to continue the war against Hamas. That's clear from the rhetoric that we're seeing today from Israeli officials. It might slightly change the shape of a conflict and offensive on the ground or the timing of it, but it doesn't seem to change the overall intent from Israel at this point.
But does Israel, Roz, actually worry about, I guess, condemnation from allies, the U.S., but also there have been others, a lot of the European leaders weighed in?
Well, not really. I mean, obviously, the relationship between the US and Israel is important for Israel, just as it is for the US. They're long-standing allies militarily, strategically, and economically, and there has been that long relationship between the US and Israel. But we've seen throughout this conflict the US expressing growing concern about the situation inside Gaza, Europe, and other countries also, and Israel proceeding regardless. And certainly the many, many phone calls we've seen happen between the leaders of the US and Israel haven't really changed that significantly. Perhaps they've slowed Israel down a bit. Perhaps they've gone in not as aggressively in some of the fighting that they've been doing inside Rafah, but it hasn't really changed the trajectory of their thinking. And certainly, if anything, it's hardened views inside Israel about what they see as their need here to continue their war against Hamas.
Roz, thank you so much. Bloomberg's EMEA News Director, Rosalind Matheson. Now, we're also looking, of course, at other news, and we continue with corporate news. Shares in Spain's Sabadell have jumped this morning after bigger rival BBVA made an €11.5 billion hostile bid days after having an initial approach rejected. Now, BBVA shares are slumping on the news. The Spanish government has already indicated its opposition to the takeover. Now, let's bring in Bloomberg's Tom Metcalf to get more on this fast-moving story. I have so many questions for you, Tom. First of all, why did BBVA go hostile?
It's so fascinating, right? It really comes back to the interactions in the last week or two with the banks. So, look, Sabadell has basically come out and effectively flatly rejected that offer. And the sense is maybe the two sides aren't really talking too well together, so they're almost talking past each other. And look, from BBVA's point of view, that rejection made them feel, right, we've got to go straight to the shareholders, direct to Sabadell shareholders. I mean, the irony is they made exactly the same offer that the Sabadell board has already rejected. So I guess they're just making a play that, hey, can the shareholders be more open to this deal? But it seems a very hard one to make if it's hostile like this with no improvement in the terms.
So what are the chances of this succeeding?
I think it's pretty low. I mean, you just mentioned the Spanish government has already come out. You know, this has literally happened almost straight after the statement saying, you know, they're not really that open to a hostile bid. So I think there's a lot of things stacking up against BBVA. We've had a few analysts say they don't really see at this price sort of the sort of sentiment there among shareholders for acceptance. So I think there's a lot of difficulties here. I think the only thing that might change it is if perhaps the two sides can find a way of coming back and starting talking to each other again. Is there any wiggle room on BBVA prices? Is this tough negotiation, or are they really sort of stopped at this point? But yeah, I don't see a route to a deal as it stands.
We're just getting actually some headlines from BBVA as you're talking, Tom. BBVA saying that the offering of shares is more attractive for Sabadell. So we'll see. This is, of course, the all-share offer for Sabadell. So I think they're putting a statement out saying why this is better.
Yeah, I think the chairman's talking to sort of media and whatnot, and obviously putting forward his side of the deal.
So they're briefing. So we may get actually more news on this. But from the Spanish government perspective, why are they against it? Or do they worry that then it's just a too large bank to regulate, or they don't want it to be hostile?
Yeah, the Spanish minister coming out and saying, I think the sense that, is it good for the economy, the consolidation, slightly less competition? But I think for me, the sense is more that, a hostile bid is just tough on both sides, what kind of job losses might result, and also just sort of the, general sense if one side isn't really into it, it's going to be a very difficult and perhaps destabilising bid deal.
Tom, thanks so much. As always, Tom Metcalf, of course, reminding us that the chairman of BBVA is briefing, so we'll see whether we have any more news from him. Much more to come. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Well, welcome back, everyone. Traders waiting for the Bank of England's rate decision. We talked about it, but also data on U.S. initial jobless claims. Now, for more on the markets, let's return to Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. Kim, thank you so much for coming back. We talked a little bit about the Fed and Fed expectations, and you're expecting actually 2 cuts from them. I guess what's incredible is that the economy is so strong, but also forecasts and expectations seem to be changing so much. How do you explain this?
Yeah, I think Q1 definitely took a lot of people by surprise, and it challenged that disinflation narrative. But for us, from what we're seeing, we still think that disinflation is going to come through the year. I think we expect moderation in Q2 versus Q1. I think, and there's many reasons for that. You know, firstly, a lot of, well, at least we're confident that part of the strength in inflation in Q1 was from erratic components. Yeah. And then we think there are a lot of lags still to come in auto and housing, and wages are still confidently going on a downtrend, which should pull down inflation. And then if you look at the broad contours of the more cyclically sensitive components of the inflation basket, those are still exhibiting disinflation. So we're looking for a moderation in Q2 versus Q1.
And then the other exciting bit is, of course, what's happening in Japan with BOJ. And I mean, we had a pretty busy week last week trying to figure out intervention. How do you see BOJ behaving?
Yeah, so the statement this morning of opinions as well, that was pretty hawkish. We think that the Bank of Japan, I think, the risks are that they will deliver more hikes, not cuts, hikes, than the market's expecting. I think what you have in Japan is strongest wage growth, wage negotiations in over 30 years. Underlying inflation is a bit more mixed, but then you've got this FX pressure that's really coming through again. Interestingly, the Bank of Japan released a paper about the non-linear impacts of FX depreciation and impact of inflation. You know, their threshold's about 15% move year on year, and we're right there with the yen. So they are getting more concerned. But, and yeah, we think they're going to have to do more than the market expects.
So, again, what does that mean? What would you be buying right now? What does it mean for portfolio building?
Yeah, I think it's the overall environment globally for duration is still constructive for income, for diversification. The Fed really put a hard stop on the hikes for now. So I think it's owning markets like the UK and the US, but being underweight Japan, where the Bank of Japan could deliver more hikes than the market expects.
Okay, so interesting. Kim, thank you so much, as always, for joining us. That was Kim Crawford there from JP Morgan Asset Management. Now, we were just talking, of course, to our Tom Metcalf, who runs all of our banking coverage in Europe, and he was reminding me that the chairman of BBVA is currently briefing reporters. This is basically him sticking to their guns and really justifying why they're going hostile and why it's an all-shares offer. The BBVA chairman saying that their offering shares is more attractive for Sabadell, but you can see BBVA down 5.7%. Sabadell maybe on expectations of something a little bit higher, gaining some 4%. Coming up, our exclusive interview with the chief executive of Google DeepMind on the future of AI in the UK and how the company's new tool could pave the way for a $100 billion drug.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, good morning, everyone, and welcome to Bloomberg UK. I'm Francie Lacroix here in London. Now, the UK government has frequently said it wants to put the country at the center of artificial intelligence, both in terms of research and regulation. Now, one of the firms that is at the cutting edge of this technology, of course, is DeepMind, a London-based startup which was bought by Google in 2014. Now, in just a moment, we'll bring you our exclusive interview with the company's chief executive and co-founder, Demis Hassabis. He shares his view on how the UK is positioned for the future of the technology. But first, the company also says its first AI-designed drugs may be ready for testing in the next couple of years, a breakthrough that could also be worth more than $100 billion.
Well, of course, the holy grail for drug discovery is not just knowing the protein structure, which is what AlphaFold 2 did, but actually designing drug compounds called ligands that bind to the protein surface. And you want to know where it binds and how strongly it binds in order for you to design the right kind of drug compound. So AlphaFold 3 is a big step in that direction of predicting protein ligand binding and how that interaction will work.
Given the technology you now have at your fingertips and everything you know about how this is progressing, what is your best guess as to what will be the first AI-derived and discovered drug?
Yeah. Well, we announced earlier on this year some big partnerships with Eli Lilly and Novartis. So we're already working on real drug programs. And I would be expecting maybe in the next couple of years, the first AI sort of designed drugs in the clinic.
Well, Demis Hassabis also spoke to Tom McKenzie about the UK's government AI Safety Summit last year and the future of artificial intelligence in the country.
I think it is moving at pace, and I'm very pleased to see government and civil service sort of embracing that. And I think the summit was a huge success. And obviously, there's the next one in Korea, and then the one next after that in Paris.
But the UK specifically,
yeah.
There's more that we can do, and there's examples of a data center that were plans to build it on the outskirts of Oxford, yeah. And it was essentially nixed by the Secretary of State in charge because essentially didn't look good. But we need those data centers. We'd be the proponents of generative AI, and we need to reform our planning laws. Is that a roadblock for the UK?
Yeah, I mean, I don't know about that specific case, but in general, we've got to make sure we embrace the enormous opportunity that AI represents, and the enormous economic opportunity for startups and business, and embrace that quickly and get on board with that quickly, as well as also for our infrastructure and services. You know, things like the health service, I think, can benefit from these technologies and allow them to be more efficient and more performative and more productive. So I think there's enormous opportunity. We have the intellectual capital here. We have, lots of leading companies here. We need to make the most of that, and I think government needs to embrace that, as well as the responsibility side, which I think the summit was about too. So I think both are important, and we shouldn't lose sight of either.
Big election year, of course, for the UK. I'm not going to push you on your political colours, Demis. But are you confident that the Labour Party, who of course have a huge polling advantage right now, are invested in AI as the Prime Minister Rishi Sunak claims to be?
I feel like from the conversations I've had, both parties understand this enormous opportunity and the responsibility that goes along with that, that's coming up, and the incredible potential AI has. So I feel pretty confident about the discussions I've had with officials from both parties.
Well, that was an exclusive interview with the Google DeepMind chief executive and co-founder Demis Hassabis. Now let's bring in Bloomberg's Mark Bergen to discuss some of the themes of that exclusive interview and the UK tech sector more broadly. So, Mark, thank you so much for joining us. I mean, you live and breathe this every day. This is like your beat, you report on it. Is he right? Is there, we know from the Chancellor that actually they want to try and make this economy, the UK, a kind of Silicon Valley. And what are the chances of that being really true?
I mean, it's certainly Demis's presence here, and DeepMind's presence is a big part of that, and I think he's fully aware of that. He's just knighted recently, so Sir Demis, actually. And I mean, he clearly has been a leading figure. He was part of this AI Safety Summit. It is a talent mecca, in part because of DeepMind and their work around life sciences, and they're drawing in a lot more. We're seeing new biotech companies and life sciences companies. It's sort of one of the strong suits of the sector in the UK. The flip side, and we've seen this past few weeks and month really, is that you're seeing companies like Darktrace kind of leaving the stock exchange. You're seeing Graphcore, which is that we talked about yesterday, the chip company in Bristol, once sort of the new kind of AI champions valued over nearly $3 billion. Looks like it's going to sell to SoftBank for much less than that. And you're seeing a lot of companies really struggle to break through and become this sort of AI superpowers that the Prime Minister has talked about.
But so again, what are the underlying causes of that? I know there's also Julia Hoggett at the London Stock Exchange trying to do a lot of work and trying to revitalize the capital markets, maybe make it easier for some of these companies to list here and not go elsewhere. But is there a concern that actually there's just not enough investment coming into the country? Does the UK ISA make a difference, or is it something more structural?
A lot of investors talk, at least the venture capitalists talk about this sort of dearth of capital at the growth stage for UK companies, right? A lot of companies, and not just in the UK, but in Europe across, are looking when they're growing at a certain stage, at kind of early, like Series B, they're looking to US investors. There's just not enough money. One of the issues has been pension reform that's talked about a lot here in London, kind of unlocking that money that's certainly in the US and Canada and Australia, other countries and others in Europe have proven to be a primary source of venture capital. I think that there's a lot of what they talk about a lot in the industry of the ecosystem issue, where you don't have as many successful companies kind of seeding new founders and new companies. That's just starting to happen, especially in spaces like biotech and life sciences, but that takes a lot of time.
Yeah, but is this up to big companies to put that investment in, or is it just also kind of retail investors that don't go into the markets like they do in the US?
I mean, we've seen Microsoft recently made a big investment here in London. At least they said they're opening up a London office. Unclear how much of that is actually be a big investment. On the retail side, it's the startups I talk to. It's not many of them have this priority about listing here, unless the only rationale I heard is kind of patriotism in some sense, of like you will be. I talked to a software a software company that might be IPO in the next few years. He said it can have a much bigger market cap and much bigger retail investors in the U.S. If here, probably has a chance of getting knighted.
So ARM, I mean, it's not a bad. I don't know if that's a good carrot, but sure. It's something. Sir Mark, do you like the sound of that? ARM shares actually are falling after the company didn't give a great annual forecast. I mean, this was the jewel in the crown actually of the UK, but they decided to list elsewhere.
Right. I mean, and this was, I think, more indicative of what we're seeing potentially of a slowdown, or at least of this the past year and a half around AI and this enthusiasm around AI. I think that the rubber is meeting the road in the sense of like, okay, now where's the demand for actual AI services? Like, what companies are actually paying for that? And ARM might be a leading indicator in some sense of it's not going to be necessarily as big as a lot of the growth potential. I mean, to be clear, like their business is still pretty strong, and I think they're kind of moving into data centers in a really interesting way. There's a lot of potential there. I think ARM is a really interesting case of like if they're going to be seeding talent, are we going to see a lot of people leaving ARM and starting companies here in the UK? That's a really interesting question.
Mark, I mean, some people say, look, it's not a great idea to be a UK company and list elsewhere, but is ARM even a UK company? Is it still considered a UK company?
Well, I'd consider it a 90% SoftBank company, so. I don't. I mean, I think most of their team. I sit here, if I'm not mistaken, but at this point, like the listing there, the SoftBank ownership. It's sort of hard to identify as a British company.
Yeah, biotech, I mean, is that, I know that, you have GlaxoSmithKline, and actually GlaxoSmithKline are also moving, I think, offices to be closer to Google and DeepMind, at King's Cross. Does that make a difference to the ecosystem?
I think so. I mean, certainly you have proponents in that kind of King's Cross, kind of that New Square Mile, talking a lot about the research potential there. You're having these new companies. Like I said, earlier, biotech is a really fast. There's certainly the university system in the UK. There's a little bit funding, but there's still a shortage of funding. But these are companies that take years, if not decades, to really fully come to fruition and build sustainable businesses. I mean, Demis talked about building isomorphic labs at Alphabet Unit into a more than $100 billion business. Alphabet's one of the few companies that has the time and the patient capital to do that. He didn't give a timeline for that in the interview today. So my sense is that that's not happening next year.
So interesting. Mark, thank you so much. Mark Bergen there, of course, looking at startups and the ecosystem here in the UK on the very latest with DeepMind. Now, coming up, money markets on edge as the Bank of England aggressively tries to clear its balance sheet of bonds. We discuss the challenges facing the governor, Andrew Bailey, ahead of our interview a little bit later. This is Bloomberg.
This is Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
Was going to keep Great World Cup.
This is a three
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Now, the Bank of England has money markets on edge about QT or quantitative tightening, with the cost of obtaining sterling cash hitting the highest level in 3 years by several metrics. Now, investors are really waiting to see if the central bank provides further guidance in a few hours from now on its policy meeting. Well, let's discuss all of this with John Stepek, author of the newsletter Money Distilled. It's very good. Everyone should have subscribed by now. If not, this is a perfect time to do it. And Marcus Ashworth from Bloomberg Opinion. You should also subscribe to Marcus' columns. Thank you both for joining us. John, when you look at the Bank of England, I know there's so much focus on rates, but actually sometimes we forget about QT or we don't talk about it as much, but it's a really powerful tool.
Yeah, it is. And I mean, I think what's most interesting here is that on the one hand, we're talking about interest rates, and we're talking about interest rates going down. So everyone's thinking, oh, when's the cut coming? When's the cut coming? And at the same time, the bank is actually, technically tightening monetary policy by doing quantitative tightening, which is the opposite of quantitative easing. And so there's a little bit of a contradiction in terms there, and obviously we're now seeing some stresses kind of building up in the markets as a result of that.
But is this, John, and I want to get to Marcus in a second, because he thinks the BOE should tailgate the ECB, not the Fed, but is this a way of calibrating it? Because if you look at inflation expectations, so sure, they dip, but they're not expected to go up. So by using these two tools, I mean, it's a bit like landing on a plane on a string, but it could work. Or could it not?
It could work, but the problem I've got is the quantitative tightening. For a start, the Bank of England is doing this, and actually the Fed and the ECB are doing far less aggressive versions of it. And the other issue with the QT is that it's actually becoming something of a political issue as well, because actually this is kind of a form of fiscal tightening. If the banks stopped doing QT, then Jeremy Hunt would have an extra 10 billion to spend this year, according to a kind of recent piece by one of our colleagues, Phil Aldrich. So you're actually kind of affecting the public finances as well in a way that's very public now. I mean, it was fine during QE because the government was getting lots of extra money to spend, but now that money's getting sucked out, it becomes much more of a political issue. And the bank needs to communicate over that, I think, much more clearly than perhaps it has.
Marcus, do you agree?
Yeah, look, I think the whole point about the Bank of England is that they did a far greater percentage of GDP, and most of their whole monetary easing was related to building up a massive bond, government bond portfolio. So they've been the most aggressive in unwinding it, and they're doing the only one that's doing what's known as active QT, which is for actual real sales of bonds going out to 50 years or whatever, back into the market. And that's the problem here. This is what's causing huge losses. And I've been very vociferous about this being an actively very bad policy, which is filtered through a bunch of other commentators, I'm sure, picked up on this as well, including notably Mervyn King. And I think that's what's altering the Bank of England's mindset. So I suspect in September, when they will, in August, sorry, they will formally review it. I think they may well drop the active part. It's only really requires 10 billion for the next following year rather than 50 this year. Yeah. Because actual passive runoffs are so large. They could quietly drop it and move on. And I think and hope that's what the market will want and to see. As far as money markets right here are concerned, it's just a little bit of tightness. I'm sure they can manage it. As we saw through the mini budget sort of crisis, LDI gilt crisis, they've got lots of different mechanisms to pump liquidity in as and when is needed. So I don't see a real problem here. I just hope they surprise us at midday and they cut interest rates.
But to both of you, I mean, that's not the base case at the moment, but to both of you, and maybe John, we start with you. What grade would you give to the Bank of England right now on a report card? Because some people are saying, look, what they're doing with QT is not right. Others are saying there's maybe an undue haste to cut rates, given that the inflation only falls temporarily to 2% and then shoots back up.
I mean, a central bank's main job is communicating. And I probably feel that the Bank of England is doing poorly on that at the moment. Because, overall, part of the problem is that central banks, we give them this sense that we have this sense that they are in control of all of this stuff, and they really aren't. I mean, they're so, you could debate the whole purpose of a central bank if you really wanted to, but in the absence of, conviction about what they're actually doing, then I think that they have to explain what they're doing better. And I don't think they're great at doing that at the moment.
But John, I mean, they're not omnipotent, but they kind of, they're steering the economy, right, quietly in a non-political sense.
Well, I mean, if you think about it, it's mad that every single month, roughly, we all sit here and debate what the bank may or may not do and may or may not say, and how that's going to affect global capital markets. It's a weird form of central planning that you've got 9 people sitting around a room, and what they do or don't do actually moves markets. It's like, why does this have any effect on the price of GSK, for example, just because Andrew Bailey raised his eyebrow in a certain direction? But it does.
I love John. This is why we have him on. He's going all like Millet on me. Marcus, I mean, what's your take?
Well, it's a family show, so I probably shouldn't say it, but I just think John's been very harsh on the lovely Bank of England. Wonderful people with marvellous insights and fabulous econometric models, which I can only admire and respect. I think they are.
Okay, Marcus, but look, I mean, the concern, Marcus, is that, and actually to both of you, is that you wouldn't want it to be political. I mean, if this then gets, maybe we have more running commentary. Is it political? But they would never. I mean, they would never. They'd really push back hard against that because they're meant to be independent.
Yeah, but their independence in some sense is political, and certainly if you look back to the mini budget and how they escape blame, I would say Bailey is world class at one thing, which was beautifully transferring all the blame onto Liz Truss, who deserved a lot of the blame, don't get me wrong. But I certainly think the Bank of England played a part in their lack of knowledge of what was going on in the gilt market prior, and their introduction of active QT right into the mini budget and refusal to do anything about, should we say, tightening and overly tightening when gilt yields are rising very rapidly going into all these things. So politically, it's, obviously we want it not to be political. They clearly want it not to be political, but unfortunately, for whatever reason, they became very political. And we certainly saw during the start of the pandemic and when we were pumping back in QE, that the Bank of England mirrored exactly what the government was doing. I mean, literally pound for pound. So in some senses, it's very hard to separate away a central bank. And I think there should be some political overlap. It shouldn't be treated as some sacrosanct independent thing. I think they need to be a little bit more conducive, particularly with regard to what John was saying earlier, and how the impact on fiscal policy is affecting us all by the huge losses they are racking up in active QT.
I mean, I still think the government actually sets the target, but this will be continued. And I have a feeling that both Marcus's column and John's newsletter today will be pretty explosive. So I would read it. Bloomberg Opinions, Marcus Ashworth and John Stepek stays with us. Coming up, we also find out why London is losing thousands of shoppers to Paris, Milan, and Madrid. That's next, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Now, thousands of tourists who used to travel to Britain for tax-free shopping are now visiting stores in Paris, Milan, and Madrid. This after the UK scrapped a tax incentive for overseas visitors. Now, for more on all of this, we're joined by Bloomberg's Jennifer Creary, and John Stepek is still with us. So, Jennifer, thank you so much for joining us. First of all, why was this actually scrapped in the UK in the first place?
Yeah, so the UK made the decision to scrap this back in 2020. You know, when the UK left the European Union, there was a discussion of whether or not to extend this regime to European Union visitors or scrap it entirely, and the government concluded that it would simply be too costly to extend the regime. And so, in a subsequent OBR report, they estimated that the government could save more than £400 million by scrapping this regime. And so the government ultimately decided to do so. But of course, this has come at the expense of many of these British retailers that say now that they're really feeling the pain.
Yes, so I was going to ask you what are businesses saying. So if you speak like someone like Burberry or some of the others, can they just book the sales in Paris and it doesn't make that much of a difference to their revenue?
Yeah, so the ones that are really feeling this are the ones with big exposure in the UK, who really rely on tourists who come in. This is particularly, international tourists that fly in from afar to spend their money in, say, London, these tourist hubs. So, for example, Mulberry, the British handbag maker, they specifically highlighted the removal of this VAT tax-free shopping regime for a dip in its UK sales at the end of last year, when it otherwise had a pretty good year. So these brands are saying, this is really impacting us.
I mean, it's impacting John's shopping, right? Always in Paris for Louis Vuitton and the rest. What's your take, John? Because, again, so they're bringing money in, but you basically lose an ecosystem where shoppers come in and go to restaurants. And so I don't know whether it's worth it. I mean, they're saying this is even, a worse downfall for the UK, the survey says, than the cost of living crisis.
The problem is it's quite a hard sell. I mean, for a start, all due respect to retailers, but you're never going to hear them calling for higher prices or higher interest rates. So there is an element of lobbying here. Also, the OBR, which, as we all know, its word is God, has said that even if you account for the tourist impact, you're still saving like nearly £500 million a year. And £500 million is quite a lot of money these days, given that we're trying to scrimp and save at various other areas. So it's hard to say, why don't we give a tax cut to a load of rich foreigners to buy luxury goods whenever, there's a lot of people kind of wanting taxes cut in other areas first.
Yeah, so is Labour's position any different on this?
Yeah, so it's not on the agenda for either of the two main political parties ahead of the upcoming general election. And so, British retailers, hope is fading for them for a change in this regime anytime soon. And, the Conservative government consider this issue to be dealt with. So it seems like that's not going to change anytime soon for retailers.
Jennifer, thank you so much. Jennifer Creary there and John Stepik. Thank you both for coming on the program. Now, a reminder to subscribe, first of all, to John's newsletter, Money Distilled, for a look at the world of markets and economics and what it all means for your money. Also, be sure to subscribe to Bloomberg's In the City podcast. I host that with Allegra Stratton and Dave Merritt as we uncover the best stories and speak to the people in the know about financial centers across the world. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from our global headquarters in New York. I'm Manus Crenny. Welcome to Bloomberg Brief. Let's set your agenda. President Biden warns the U.S. will hold back more weapons if Israel invades Rafah. He calls the potential loss of civilian life just wrong. Arm tumbles after giving a lackluster annual revenue forecast, raising concerns that the tech industry's AI spending spree may slow. And the BOE expected to hold rates steady today, but Governor Bailey may signal when the central bank is ready to start cutting rates. A very good morning to you. We've stalled. We've stalled in the bond markets. We've paused in the rally in the equity markets. We're down 1/4%. ARM missed on the guidance, and down she went, tanking at one stage by 10%, down 8.25% at the moment. So there's just a bit of a headwind. There's a headwind in the bond market. Yields are rising ever so slightly. Equities pause for thought. With that in mind, we're talking about the flow. Citi say the flow. There's limited enthusiasm in terms of participating. New longs have drained to a trickle. Keep an eye on Airbnb, down 7.79%. Again, a slowdown in booking ahead of the summer peak. Or is it a crack in the U.S. consumer? That's what you want to ask yourself. Bonds rise. I mean, we had yields rise. We had a drop in yields for 5 straight days. We went into $42 billion worth of tens. The demand was tepid. What does tepid mean? It's a bid to cover ratio of 2.49, pretty much in line. It just wasn't enough to drive the yields lower. $25 billion worth of 30-year paper come today. Let's see whether we can absorb that easily. We're counting down to the Bank of England. We'll catch up with Lizzie Burden a little bit later on. Sub 125, 124.74. How dovish of a tilt is already in this price? Will there be a split in the vote? So we're talking about central banks. The Bank of England, that piece of theatre will come a little bit later on. But to the Fed and the Fed speak. The Boston Fed President, Susan Collins, signaled more confidence is needed that inflation is moving towards 2% before moving on rates.
There's a significant amount of uncertainty around that outlook, and the recent data lead me to believe that it's just going to take longer than previously thought.
Henrietta Bacamon is the head of global fixed income at Allspring Global Investors. Henrietta, welcome to the show. Good to see you this morning. So there's a hesitancy in Collins, and that is the building narrative from everybody. In your view, these insurance cuts have re-entered the market, 2 cuts. Is that what you see, or what does higher for longer really mean for you in your position?
Yes, we've had a backup in rates, and we peaked out on the 10-year in the US at about 470.
and we're about, call it 20 basis points lower than that at this point. And yes, I agree. You know, the latest inflation prints that we've seen have been a little higher than expected, particularly on the US side, and that's what the central banks are reacting to at this point. So it's pushed out rate cuts. You know, for us, it's going to be 1 or 2, you know, possibly starting in the autumn or December, because we've got the US elections, which is you know, going to take the November cut out in our minds.
I thought her language was particularly rich. She talked about a methodical perseverance to take time, and it's going to continue. It's going to be uneven. I'm curious to understand what you see as being some of the cracks. US exceptionalism seems to be showing the initial chinks in the armor. Now, this is a refreshing opinion because everybody, to a man and woman, have come on this show and they evangelize that exceptionalism. What is it that's potentially breaking there in that vision for you?
So it's been really interesting, really, in the last few weeks to sort of see a change in that sense. What we have had, you know, towards the tail end of last year, even the beginning of this year, is US data surprise to the upside. What we've seen in the last few weeks is actually US data surprise to the downside in a variety of areas. So, you know, is it a slowdown or is it more of a normalization of what we've seen in the US? Obviously, the US is the exception. The fiscal side has been tremendously generous there, and we've seen the impact there. But, you know, it just feels as if, you know, some of that may be turning. And conversely, if you look at European data, there we've had slightly, you know, more positive surprises, where, you know, the growth picture in Europe is certainly more lackluster.
Well, certainly this imagery of divergence is taking hold, isn't it, between possibly 1, 2 cuts in the US, but 3 cuts in Europe, and that divergence is manifest. How has that, I know that you've closed some of your tactical shorts here in the US, but talk to me about that divergence and how you're preparing, are you preparing for that in a more significant way? Bank of England today, ECB, the estimate is 3 cuts, US 2 cuts, so divergence really does begin to settle.
Yeah. So if you look back to the beginning of the year, we thought the markets had gone too far. So hence, you know, we had some short positions on the rate side. So we have pared those back, you know, given the moves that we've seen. However, what we have kept is diversification across interest rate environments. Why? Because we've got sort of slightly different trends playing out, both from an inflation and from a growth perspective globally. So, you know, we expect, you know, some of that divergence to help us from a risk-return perspective in our portfolios. So, like that diversification at this point in time. In terms of sequencing,
yep.
Oh, go for it.
No, please jump. Go ahead. Finish the thought.
So no, and you know, whereas last year there was more of a homogeneous sequencing between central banks, that has now changed. And from our perspective, you know, the sequencing that we see now is ECB first, then Bank of England, then Fed, obviously later in the year.
Okay, and with that in mind, what does that do to the bond narrative? I mean, we saw a my favorite word of the week is recalibration, which is that 22 basis points drop in the 10s, in the 5s, sub 5% in the 5s. So we recalibrated in the United States of America, lower in the bond markets, lower in yield. The Bank of England will come today. A lot of people are sort of saying sterling's already pricing in a dovish tilt. To what extent do you think that narrative, that shift to dovish narrative from the Bank of England is already there? I mean, the market's pricing in 1 full cut by August.
Yes, I think the markets have reacted to that, both on the bond side and the currency side. Obviously, sterling has come off its peaks late last year. And we think that makes sense. In a way, the UK is in a funny situation. From a growth perspective, it looks more like Europe. From an inflation perspective, it looks a bit more like the US. So that's the kind of you know, dynamic that the Bank of England is looking to deal with at this point in time.
I love the phrase that you have here, that the US is detaching itself from the rest of the world, and it seems to be having more trouble with sticky inflation. And that really sort of plays to what you've just said. The UK is ahead, Europe is ahead on that front. What is it that's going to materially shift the inflation outlook here? I've had various people say to me it's the housing component, it's the services inflation, but what is it in your mind will shift the gears for the Fed to enable them to pull the trigger on the dry powder that they have?
So two things. Obviously the housing piece is slower moving, and I think that's well appreciated. So for us, it really is that service component and making sure that that one is showing the trend that they want from a level perspective down. And don't forget that the Fed has got that dual mandate on the inflation side, but also on the employment side. So we're also keeping an eye out on what's happening there, because they will be obviously very sensitive to any deterioration on the employment side.
Okay, let's see what the Bank of England does deliver. We'll cover that through the morning. Henrietta, thank you so much for being with us. Henrietta Bacamont, Allspring Global Investors. Other top stories for you trending on your Bloomberg terminal this morning? Here's what we've got. Blackstone President John Gray says the Fed will be patient in cutting rates due to stubborn inflation. But he sees it making one cut this year as U.S. growth decelerates. China's exports rose slightly, more than expected in April. It was a boost for the economy. Exports increased 1.5% in dollar terms from a year earlier, reversing a drop in March, while imports climbed 8.4%. The jump in imports was largely driven by products such as chips and PC parts. BBVA has launched a hostile bid for its rival, Sabadell. The all-share offer comes just days after an earlier $12 billion approach was rejected. The Spanish government criticized the move and said it could be negative for the industry. Elon Musk's artificial intelligence startup XAI is set to close its funding round at a valuation of $18 billion. That's according to people familiar with the matter. The size of the round hasn't yet been finalized. And ARM stock, as I said to you, has been falling in the pre-market. The company issues a tepid annual forecast. We break down the results this hour. The stock down over 8%. And Biden's warning. The president says he would halt additional weapon shipments to Israel if there is an invasion of Rafah. Context matters on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Middle Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
I made it clear that if they go into Rafah, they haven't gone on Rafah yet. If they go into Rafah, I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks like came out in the Middle East recently.
That was President Biden speaking last night on CNN. Joining me now is Ros Matheson. Ros, obviously this language that the president has used is an escalation in terms of what he's prepared to do. Can you put some context around this for me, the gravity of the shift in language?
Well, certainly it's a big symbolic step from the US to block a shipment of weapons to Israel. You know, 70% of Israel's military imports come from the US, so they're a really key supplier. And the US, for the first time in a while, is saying, we don't want to send you a certain type of weapon because we're worried about where it's going to be used. Namely, would those heavy bombs be deployed by the Israeli military in the offensive in Rafah? And what the US seems to be doing is trying to divide a line between offensive weapons and defensive weapons. So you've got offensive weapons that could be used in a Rafah offensive, again, that area of high popularity density of civilians. And then you've got defensive weapons, which would be used for Israel to defend itself, particularly, again, its Iron Dome missile shield. And the US has been very clear it respects the right of Israel to defend itself. It also says it respects the right of Israel to move against Hamas and try and eradicate Hamas. So they're walking a bit of a line here. They're just trying to be very specific about certain kinds of weapons. For optic reasons, you don't want those heavy weapons being then used by the Israeli military in Rafah. But obviously, this is a step that either way is going to substantially increase the tension between Israel and the US over this decision.
And it's interesting, of course, in the story in the Journal in March, Danny and I were looking at this on MSNBC. He warned that an Israeli offensive on Rafah would cross a red line, but then he quickly added, there is no red line that I'm going to cut off all weapons. So this is a significant shift, and Austin warns, the defense secretary warns of casualties on the battlefield. In terms of other weapon shipments that the US could potentially stop, where does that go to?
Well, it's primarily, again, those heavy weapons. And so it's either bombs or it's equipment that allows you to modify bombs to make them more targeted. So the US sells Israel a lot of kind of less guided missiles. So these are, you know, making them more targeted. You add things to them. It's called tail kit, and that allows them to be more specific in Rafah. And again, that's probably what the US would be, Israel rather, would be using in further airstrikes in Rafah. So it's anything of that very heavy artillery, bombing nature that they want to cut off. It's not things like ammunition, for example, or again, things that Israel is using for its own defense, its missile shield called Iron Dome. So they're trying to walk that line, as you say. I mean, any politician who draws a red line is probably always going to regret it at some point. History is littered with examples of politicians who've drawn red lines only to blow through them or to have to kind of change them as time has gone on. But what he did say at the time, he was very clear, is we're not going to cut off all weapons. So I guess in this case, what they're saying is they may look again at any offensive weapons, but they're going to continue to supply Israel with defensive ones.
Ros, I think at the heart of it, people are trying to assess if this is a last major military escalation by Israel in this offensive on Rafah. Your sense in terms of the shift, and I'm also curious to get your take just briefly in terms of the power of Biden over Netanyahu, because this is almost as if it's a pincer moment in this relationship.
Well, certainly, I mean, you look at the rhetoric from some of the Israeli ministers who've been speaking overnight, and many of them are, you know, on the hard right, so they've been pushing aggressively for that war in Gaza, and they've come out publicly and said Israel cannot be taking its lead from the US. Israel has to continue on the path that it's on for its own reasons, and so very strong rhetoric. Benjamin Netanyahu has not been drawn into that. He's not talking publicly, but obviously there's a strong sense of anger and frustration happening in Israel over this. And we know from all the phone calls that have happened between Joe Biden and Benjamin Netanyahu, I mean, several a week at some point, that Israel is still proceeding regardless. Is there any change in behaviour coming from that? They might be slowing down a bit. Their operations a bit more targeted as a result, certainly, you know, feeling the pressure to be attuned to the risk of civilian casualties and all of this. They are slowing down, adjusting perhaps. Are they going to change their overall goals? Absolutely not.
Certainly doesn't look like it. Ros, thank you very much. Ros Matheson, tracking the very latest on Israel-Hamas. Colleges and universities all over the world are grappling with protests against Israel. Starwood Capital CEO Barry Sternlicht spoke to Bloomberg's David Weston about the demonstrations at the Milken Conference.
Encourage free speech and debate, not violence, not hate speech. No child should have a fear for his safety walking around the university campus. Get rid of the agitators. I mean, it should occur to somebody that the attack on Israel on October 7th was right. The rumor was the Saudi-Israeli peace conflict was going to be solved. This well-orchestrated campus demonstration happened after Iran shot 300 missiles into Israel, and Israel responded with sort of a light touch, like, we can get you, but you know we're here. And then they pulled back, right? Because the administration said, don't do anything. And they kind of did, but nothing, right? World sentiment was shifting against Israel. Unleash the Kraken. Let the kids protest all across the United States campuses. It was well orchestrated by these SJP and all these organizations that are being funded by some left-wing organizations. If I were the President of Brown, I would say, we stand with the democracies and free speech. We stand, Israel's not an apartheid state. Here's the proof. Israel's not committing genocide. Here's the proof. If you don't like it, I understand. That's great. Leave your keys on my desk and go to another university. Ben Sass did that. That's what all these university presidents should do. They should stand up. By the way, open the doors, have a debate. Invite the people on both sides, but have that debate and let the children see the facts and then understand the situation and then make a decision. I assume these people aren't all anti-Semitic. I assume it's not because all these children want to kill all the Jews in the world. I just think it's naive, it's sad, it's offensive, and actually, my father survived Germany, so I have a lot to say. I'm just not going to be quiet about it.
It's clear you feel strongly about it. A lot of people feel strongly about it. But when you make a decision like, I'm not going to contribute for the time being, is that an expression of your views, your principles, the things you were talking about, or is it an attempt to change behavior? Do you think it'll go beyond an expression to actually change behavior?
Look, I don't think these universities. Christina Paxson's a great president at Brown University. She's trying really hard. She's got a. These universities have very left-leaning faculties. You should not have a tenured professor who said there was no Holocaust. How can you teach that at Columbia University? How could that person have a job? And if you thought that was fair, if you had a professor who said there was no slavery, it didn't happen, would you have him as a tenured professor? Or if a professor who's saying he celebrates and thinks that at Cornell, who thought the Hamas should be celebrated, killing innocent children and parents. I mean, they should be shown the door. And I don't want to pay for them, so I don't want to support a university that houses that language. So I'm just saying, like, who would do that? You support those who support you. And I'm not, again, I understand if I would like there to be a government on the other side for Israel to make peace with. I'm not a supporter of Netanyahu. He needs to go because I don't think he's the guy to make peace on the Israeli side. But there's a significant number of Israelis that want peace, majority. I'm not so sure that's true right now on the Palestinian side.
Starwood Capital's Barry Sternlicht there speaking to Bloomberg's David Weston right here on Bloomberg, where context matters. Good morning from New York.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg Brief. I'm Manus Cranny in New York. You'll see Danny Berger in about 30 minutes. She's joining the surveillance team. Let me get you up to speed with the front pages. These are the news headlines from around the world. First up, you've got the New York Times. President Biden proposing barriers to Chinese electric vehicles, steel and other goods. We're in full electioneering mode here. Advise fresh measures. The attempt is to protect manufacturing and the agenda. And warning against the surge of cheap Chinese imports. Next up, Mike Johnson survived an attempt to oust him. This was as House Speaker. Now, the House rejected Republican Congresswoman Marjorie Taylor Greene's bid to unseat Johnson. The vote ensures Johnson remains for now until after the November election. Leaning on your Democratic friends, how safe is that? Okay, Disney Plus. I mean, if you haven't had a bundle, here's a bundle for you. Disney Plus, Hulu, and Max. Yeah, you got it. They've sold... they will be sold in a new streaming bundle. It's going to start in the summer, as if you need another one on the telly. They announced this on Wednesday, and the pricing details, we'll get those a little bit later on. Viewers can access Disney, Warner Brothers movies, and TV shows under one service. It's not that bad an option. Now, we're counting down to the Bank of England. We'll catch up with Lizzie Burden a little bit later on. She's outside Threadneedle Street. But this bond market is repricing. And maybe the UK bond market got slightly ahead of itself with that dovish tilt from the Bank of England a little bit earlier in the year. But yields are rising as we're counting down to a $25 billion worth of 30-year bonds, as there was a tepid demand for 10s yesterday.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped. and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
From our global headquarters in New York, I'm Menace Crenny. Let's set your agenda. President Biden warns the U.S. will hold back more weapons if Israel invades Rafah. He calls the potential loss of civilian life just wrong. ARM tumbles, giving a lackluster annual revenue forecast, raising the concerns that the tech industry's AI spending spree may slow. And the BOE is expected to hold rates steady today, but Governor Bailey may signal when the central bank is ready to start cutting. A very good morning. Good to see you. Nervous and pause for thought is the reflection of the equity market, down 1/3 Yields are yields are rising incrementally. I mean, they're up a couple of basis points. You're hardly going to sort of wreck the equity market with that. But the underbelly of what corporates are reporting is what's irking the market. You look at the ARM guidance, stock is down 9% this morning. Again, just a tepid indication of what's going on that front. It was down over 10% at one juncture. Airbnb, they're going to have lighter bookings between now and the peak season in the summer. Again, is that an incremental fissure in the consumer around the world and here in America? Down 8% at the moment. I talked about the bond market. You had, again, another record bond auction yesterday, $42 billion worth of 10-year paper. Again, we had one of those in February. It backed up a little bit. It was tepid. I think that's the word that most people would use to describe. The bid-to-cover ratio was 2.49, pretty much in line with the average, but they didn't gorge on it, and I think there's the disappointment. There's sterling. She's down 0.2%. We need a clearer signal from the Bank of England that they are on that easing cycle, and that it is coming. The market right now, 50-50 for June. A probability of one full cut in August, and we've just heard from Henrietta Bacamont saying that you're going to get cuts from the ECB and the UK well ahead of the Fed. That's the current thinking on divergence in the market. But when it comes to the narrative around inflation, quantitative tightening, we caught up with the Guggenheim CIO. It was Ann Walsh. She spoke to Bloomberg at the Milken Conference to discuss the Fed's path amid this deficit spending.
In quantitative tightening in the U.S., the balance sheet has been reduced from $9 trillion down to about $7.4 trillion. But when you think about the fact that deficit spending has been to the tune of about $2 trillion in that same time frame, it's really been almost perfectly offset by fiscal deficit spending at this point. And that is inflationary, and it makes the Fed's job harder. It's two forces working against each other.
Collision of mighty forces, fiscal spending and QT. Joining me now, it is Frank Munkham, Senior Portfolio Manager over at Antimo. Good to see you this morning.
Hey, man, it's a pleasure to be here today.
So, Anne, I think, really contextualizes the conundrum for the bond market. Fiscal juice, keeping the dream alive, keeping the pro-risk dream alive, and QT on the other side. I mean, when I look at risk, do we just perpetuate? Because nobody's stepping back from the fiscal pulse, either now or even potentially going into a change of administration into 2025. We had a moment of where the bond market woke up last autumn and it worried about deficits, and we've just dispensed with it up until now. Are we still right to dispense with a concern about the fiscal situation?
I think the fiscal situation is still one that we need to be concerned about. I don't think that's going away anytime soon. You know, if you look at what's happening in the bond market, just recently, we had the Fed meeting last week, and they made somewhat of a dovish pivot, so to speak. But when you really look at what's happening with supply dynamics in the bond market, I think rallies here are really probably need to be sold. You know, the convexity to the bond market is probably to the upside in terms of when we see a reaction function to you know, bearish data or even dovish rhetoric from the Fed. The bond market tends to rally really fast, and I think these rallies are probably you know, need to be sold here because.
Do you think we got a little bit too exuberant? I mean, the question, Danny and I, she's going to be on a little bit later. We're talking about term premium, and I go with your narrative. The question is, if I look at term premium, it bounced a little bit higher. It's come back. This is what we've got in term premium. My question would be, is there enough term premium? And you're a pro, so you tell me, is there enough term premium there to compensate you for those fiscal risks, for the sticky inflation and the higher for longer narrative? Yeah,
I don't think there's enough term premium in the bond market. I think it's very likely that we revisit the upper end of the range on yields here, probably closer to 5%. I think what's happened recently is that, you know, you've got a bit of a carry, an appetite for carry in the bond market. That's what's keeping the bond market sort of bid here. But the duration story really isn't what investors are looking at. It's too early to really put duration bets in the bond market at the moment. But with yields being 4.25%, 4.50 on the 10-year, it's really attractive from a yield hunting perspective, especially since investors haven't seen these level of yields for a long time. So the play here is more of a carry play than a duration play. But carry plays are never really sustainable when you have the kind of fiscal dynamics that we have in the U.S. So I suspect that as the market, you know, comes to grips that the Fed is not really ready to ease here. I mean, they did pivot a little bit, saying that, you know, shaving off the right tail of the policy distribution, saying that they're not going to be hiking. It doesn't mean that they're ready to be easing anytime soon. So I think when we have more clarity on that, you know, going into the end of Q2 and Q3, I think we're probably going to revisit the high end of the range here on yields, probably close to 5%.
Listen, I think Collins was very prescient last night. She talked about a methodical perseverance. So this is not a Fed for yielding. Now I want to get to your equities market. I mean, we've lightened up a little bit on this equity market. Yesterday we were battered by tech, really, weren't we? But this is your stance. Equities have yet to reprice the zero Fed cut scenario, which is your base case scenario. 60% of the equity returns since that dovish pivot in the fourth quarter of 2023, who can forget, has it been attributed to valuations as opposed to earnings. Now, how impressed or unimpressed are you by the earnings? Look at Airbnb this morning. Look at ARM yesterday. Look at Intel yesterday. Yeah. Again, look, it's not blow away demolition in earnings, but it's subpar. Yeah. And they were supposed to supplant. They were supposed to carry us through. Yeah. Have they? Will they?
I think it's subpar earnings, and you're really seeing the way that the market is rewarding companies that are beating on earnings today. It's been a very tepid, feeble reaction to earning beats. But on the flip side of it, the companies that have missed have been, you know, punished pretty severely. So it just goes to show the undertone of the market at this stage. And to my point about equities having repriced, you know, my base case, which is the Fed staying on hold through the balance of the year, is that, you know, you've got, since, you know, the Fed pivoted in Q4 last year, you've got a rally in equity that basically was driven, 60% of it, in my opinion, based on my modeling, was based on the fact that, you know, the Fed is going to cut about 6 times in 2024. So we've repriced that. The bond market has repriced it to some extent. Definitely the swaps market now has about 1.5 cuts for the balance of the year. But the equities market is yet to
Are we living on a dream? We're living on a prayer in the end?
Yeah, but I think there's been a cocktail of bullish callous here recently with earnings season, and you know, we got out of the Israel weekend where things were, you know, massively oversold, and getting to earnings season, you know, buybacks, blackouts came off, and there was just a lot of, you know, just temporary tailwinds here for equities that kind of propped us up. But I think we're facing some resistance here around some moving averages, and once the market comes to grips that the Fed is not ready to hike, especially not ready to ease, especially as we see CPI next week, which is expected to be fairly hot. I think we'll probably retrace a little bit to the downside here towards the 200-day moving average on the S&P, which is around 4,800.
So you've got a 4 to 5% drawdown in equities at that stage. I mean, yesterday's debate, it's interesting, yesterday's debate from a lot of guests was around the growth to value narrative. So if you're going for possibly zero cuts, that's probably your worst case scenario. A little bit of a slowdown. What does that do in terms of how you want to be positioned? This equity market could draw down by 4 to 5%. So do you want to be tactically short into this, or do you just want to pare back risk?
Sure. So in terms of positioning, I mean, everyone try to stay away from such as, this radioactive word that is the S word, that is stagflation. Maybe you are not there, but we've seen some things that are similar to that. I mean, if you see the divergence between, inflation surprises and economic surprises, it's really getting pretty blatant here. And in terms of positioning, I just think that, the equities market is not necessarily going to turn off some bearish here, but I think a 4 to 5% correction from these levels to kind of reprice, the Fed, not cutting this year is probably the way to play it. And in the bond market, I think you just want to sell rallies, not necessarily want to be outright short, but, fade rallies here. And I think one of the trades that I find to be really attractive at the moment is commodity space, especially given the pullback that we've seen from gold, from oil. Positioning, especially in crude oil, seems to be a lot cleaner than it was, 2-3 weeks ago. Going into the,
do you think there's a potential re-entry into the commodity space on these minor drawdowns?
I think so, and I think the thesis here will be slightly different. It's no longer geopolitical risk premium that investors should be looking at, but it's more so kind of a inflation trade or inflation hedge and a carry play with raw yields being so attractive.
How real is this stagflation risk? They're angry with me. I'm going over time here, but sure. I love a contrarian left tail call. Everybody else has got cloth ears about stagflation. You haven't.
Well, I think stagflation is a pretty strong word, right? And there's a spectrum to that, right? I mean, you don't have to be necessarily in full-blown stagflation mode, but it could be something that resembles that. And I think we're starting to see signs of that. And the way to position for that is to be, in my opinion, to be kind of technically fading rates here. Look for a small equity correction here over the next couple of months, and be long commodities because of the raw yield and the reflation hedges that it provides.
Frank, thank you very much. And you're right, there is a spectrum of stagflation. It just depends. It's not 1970, as some people have said to me. Frank, thank you very much. Frank Monkham there of Antimo. My guest on the markets. Coming up, stock in ARM falls pre-market after a disappointing outlook. More on the context of the move on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
I think AI is overhyped in the short term and probably underestimated over the long term, like what it's going to bring. And I think that's probably true of a lot of breakthrough technologies. So I think we're seeing, because of the popularity of AI now in the last couple of years, lots of people trying to get into this space who maybe haven't thought about this as long as people like us who've been in it for decades. And I think we're going to see a sort of rationalization process happening.
Well, the stock in ARM is extending this post-earnings decline. This is after the chip designer gave what's been described as a tepid forecast. And it comes after Palantir rides the AI enthusiasm with a boost in their outlook. Alex Webb is with me. Was this just a reaction, Alex, because so much bullishness was priced into ARM earlier in the spring, wasn't it?
Yeah, we saw in their last set of earnings that actually the forecast was slightly better than the market was expecting, and we saw a huge, boost in the share price as a consequence. We've gradually seen, the price to earnings multiple come down a little bit. That's obviously as some of the estimates have been revised, but it's still been trading at a significant premium even to Nvidia, which of course is not doing too badly itself. And a lot of it is to do with the gauging of just how much exposure to AI ARM has. Now, it doesn't really have direct exposure per se, but as new data centers are kitted out with the chips from Nvidia, amongst others, they need some of the chipsets that are designed by ARM. What we're seeing here is that it's not quite as rosy as some had hoped.
Do you think that reflects something about the CapEx, or not so much CapEx, but perhaps technology spend overall?
Well, I think with ARM in particular, it's sometimes quite easy to forget that their main businesses are sort of for, mobile, for smartphones, and also for the internet of things and sort of heavy industry, like their chipsets go into factories and the things they design. Now, when those industries are having a problem, or at least not growing as quickly as people would like, then ARM feels that, and that is really the case here. They have a growing exposure to data centers. It isn't actually their core business just yet.
Yeah, and there's a few other articles floating around about Mr. Hess's desire to get a little bit more expanded into the auto business at a delicate moment. Alex, thank you very much. Checking out the stock there under pressure. More on the earnings front. This is what we've got for you with Warner Brothers. They're set to report before the bell as it plans for additional cost cuts and price hikes. Never good news for the consumer on that front. Charlie Wells is with me. Charlie, good to see you. Is this going to be enough to turn the company's share price around? That's really what we want to know.
Yeah, I mean, this is a share price that's been under pressure really since that merger between Warner and Discovery in 2022. The share price is down about 70% since that peak back in 2022. And look, that merger created a company that is now the parent of CNN, of HBO, of Warner Brothers Studios, but it's also a company that had $50 billion in debt. CEO David Zaslav has managed to slash that by $13 billion, which is pretty good. But people familiar with the matter are saying that he's telling top lieutenants they need to find more ways to cut costs. People familiar with the matter have said that could include some job cuts. There have already been 2,000 job cuts at this company. People familiar with the matter also said that the company will be raising prices for its streaming services. Now, is that enough to turn this around? I mean, we've heard that cost-cutting story before, and we also know that all the major streaming platforms have been increasing their prices. So when they report in just a few hours, there's going to need to be a rabbit out of a magic hat in order to really turn that share price direction around.
Well, tell me this then: Warner and Disney getting together, selling their streaming services together. I mean, is that a rabbit coming out of the streaming hat? Is that the, to use your phrase, Charlie, stole it there. I mean, is that a rabbit out of the hat in streaming?
Look, I mean, this bundling is something that people have talked about for a long time, and I would just say once upon a time there was something called cable television, and you could sit down and just go through high-quality content without thinking about who was producing what. And so it's looking like some of these streamers are starting to realize, they're traditional media brands, they need to get into streaming, but they can't do it alone if they want to compete on the level and scale that Netflix has.
I can't take any more icons on the telly. I know that I'm paying for a lot of them. I'm just too frightened to add it up. Charlie, thank you very much. Charlie Wells on the latest equity market stories. Let me just show you what's going on across these markets as we're counting down towards the next big bond auction, which is the 30-year government bond auction. Yields are ticking up ever so slightly. We're waiting for $25 billion worth of 30-year paper. Bloomberg Dollar Index up by an eighth of 1%, and equity markets just lighter on their feet this morning. Yesterday it was the damage from Intel, Uber, and Tesla. This morning it is Airbnb that is punishing, taking a punishing pre-market. Coming up, we're going to set you trading day right here on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Brief, very good morning. I'm Manus Cranny in New York. Here's a look at what's ahead for you today. We've got Roblox, Warner Brothers, and Tapestry reporting earnings. That's before the bell. Throughout the day, we'll get interviews from Bloomberg Tech Conference in San Francisco, and the CEOs of Snap and Arm join us with a little bit more detail. Before all of that, it is the Bank of England announcing their rate decision at 7 a.m. Eastern. And the Bank of England is expected to keep rates unchanged at 5.25%. That is a 16-year high. The Governor, Andrew Bailey, may give a stronger signal that the central bank can lower borrowing costs from their current 16-year high. Lizzie Burton is with us. She is our UK correspondent. Lizzie, good to see you. So So much dovishness has been priced into this. I just wonder, is the bar sort of high for disappointment? Talk me through what we think we're going to get.
Well, at the moment, markets don't expect the Bank of England to cut till August, so you could get a bit more dovishness and see bets changing for more than a 40% chance of a June cut off the back of this. There's so much focus today on when the first cut will be, but also the cuts beyond that. So in terms of clues, Manus, first of all, look at what they say in the guidance. I doubt we'll get the clarity as the same as the Riksbank gave yesterday, saying that you'll have X number of cuts this year, but you could get a tweak to the language saying that they favour a cut in the coming months. Maybe they follow ECB President Christine Lagarde's lead and tell us which data they're watching as a wink-wink as to whether it will be June or August. Also mind the vote split. Does Dave Ramsden join Swati Dingra in voting to cut? Would that be a signal to markets? And then finally, the forecast as well. If they see inflation undershooting the target, it would be a pushback against the market curve.
I mean, they're in a fundamentally different position to where we are here, which is this higher, sticky, intransigent inflation, which they're battling against. Structurally, you're much closer to 2% than we are here, or they are in Europe. So where is the gilt market positioned in terms of its inflation outlook?
Well, you're right, Manus. I'd just say that it's taken a long time, but Andrew Bailey, the governor, has finally acknowledged that the UK inflation story is closer to the ECB's than the Fed's, and therefore you could see the Bank of England cutting rates more in line with the ECB than the Fed. And in terms of the market reaction, you could see a bit of repricing if there are these dovish signals where you get a boost to gilts and a drop in sterling. But lots of economists in their notes about this meeting pointing out that the exchange rate is a bit overplayed in the Bank of England's case, because more of our trade is with Europe than with the US. If we're more in line with the ECB than the Fed, it's that pairing that matters. You won't see too much weakness against the euro. And really, if you have a little boost to growth via the exchange rate, maybe that's more of a feature than a bug.
What role does politics play in the British narrative? I mean, we're in an election year. We don't quite know when that's going to be, but certainly the intimation has been that the current government, I think, to paraphrase, could do with a feel-good boost, to quote one of the politicians.
Not just one politician, it was the Chancellor Jeremy Hunt himself, with an eye on a potential autumn election. Look, this is what the politicians in Downing Street want. Cuts as soon as possible, even if the Bank of England's independent. They're not the only ones who are going to put pressure on the BOE for cuts when they start. You're also going to have pressure from markets if inflation falls below that 2% target before the August meeting. It's going to be incredibly difficult for the BOE not to cut if inflation's already at 2%.
And then there's the whole political debate about QT and what that would do, perhaps for the Exchequer at number 11 Downing Street in terms of the ability to move on taxes. Oh, yeah, love politics and taxation. Lizzie, thank you very much. Good to see you. And we look forward to the coverage there. And stay with Bloomberg for full coverage of the Bank of England decision, plus the interview with the governor himself, Andrew Bailey. Will sit down with Bloomberg a little bit later on. So we'll get the nuts and bolts of what he really thinks about the inflation trajectory, the propensity to cut rates, and clarity around any shift on the voting on the board. Snapshot of equity movers for you. This is what we got for you. Airbnb, as we said, lackluster guidance in the second quarter, indicating that growth in travel spending might slow further before the peak in the summer kicks in. Robinhood Markets posted a second straight quarterly profit as higher interest rates and cryptocurrency trading fueled the growth. And then you have WBD. Warner Brothers up 3.33%. They're going to report before the bell. They're planning cost cuts as well as price hikes potentially in their streaming service. Let's take a break, and we are counting down to that all-important $25 billion worth of 30-year paper, testing the bond markets on Bloomberg. Good morning from New York.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
In terms of the soft landing playbook, that's still up in the air.
We do think that we're going to see more of a soft patch.
I think it's important to recognize that the balance of risk has shifted when we talk about rates.
I think every meeting is open to the Federal Reserve. You either go in September or we wait until December, but I wouldn't rule anything out.
Their biggest concern is if things go south, how fast do they go south, and what do we really do?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Bramo got so bored of this market, she's taken the next 2 days off. 51.8770 at the close on Tuesday. On Wednesday, yesterday, 51.8767. This equity market going absolutely nowhere. Danny Berger's in the hot seat this morning. Good morning to you all. This is Bloomberg Surveillance. AMH is down in Washington, D.C., and we've got a lot to talk about, starting with central bank decisions. Some might say the global easing cycle is underway. First out the gate, the S&P, quickly following Sweden's Riksbank. Will the ECB and Bank of England make a move, Danny Berger, in the next couple of months?
So I see this. You brought the fake Brit onto the BOE
to join the real Brit.
To join the real Brit. Fair enough. I mean, I most recently lived in the UK. But this is the thing. The Swiss and the Swedish have already shown us there's a willingness to go, not even just before the Fed, but before the ECB. The concern, of course, is currency weakness. Deutsche Bank has gamed this out, saying, actually, the sterling will move less than it has in the past decade, that the rate sensitivity is just not as big as it used to be. Sterling right now, 124.87. That decision about 60 minutes away. If you want some drama, as we've been doing over the last couple of weeks, Danny, you go to dollar yen, 155.92. That currency pair positive by 0.25%. The yen has been weaker every single day this week in the face of increasing criticism coming from officials both at the Ministry of Finance and now the BOJ. Yeah, what a slap in the face. Not only has it been weaker, but we've consistently seen this market and hedge funds willing to go to 160, willing to put those option pairs on. It might be an issue of credibility, but John, one thing we forget is that the BOJ is not independent in the sense that we think about the Fed, we think about the ECB. It's part of the Japanese government. They were just speaking days ago, of course, Ueda and Kishida. And then we get this outcome. It's a very, very different central bank. We'll be talking about some of those moves later in the program. Need to talk about these big moves in the equity market as well. If you've missed this week, come anywhere close to missing, you've been absolutely punished. I'm thinking about the close to 10% move we saw in the Walt Disney Company
earlier on this week. ARM Holdings is down by about 8.5% in the pre-market. It doesn't take much in this equity market at the moment to trigger an outsized move in response to those earnings.
The sentiment has shifted. There's no doubt. Usually when you see a move like that, you think, what a great opportunity to buy the dip. Something is different this time around. You see it in the flows. People have reduced their shorts, but they're not putting on new longs. Things are expensive out there, and perhaps with the uncertainty and the volatility of every economic data point, and earnings needs to be perfect to buy.
Let's get to the broader price action for you and kick things off with this. We're pulling back by 0.25% on the S&P 500. Just a little bit softer here. 5 days with no real losses. Here's your pullback. Not much of one, is it? Yields are higher by a basis point or two. We're back in the 450s on a 10-year. 451 in the FX market. The euro just a touch weaker here. Euro dollar 107.31. Coming up this hour, we'll catch up with Russ Kostrick at BlackRock as equities snap a 4-day winning streak. Ed Mills of Raymond James as President Biden sends a warning to Israel, and Sarah House of Wells Fargo with investors looking ahead to CPI next week. We begin with our top story, the S&P 500 treading water after delivering its biggest 4-day advance this year. Russ Kostrick of BlackRock saying this: we remain overweight equities based primarily on our views surrounding strong earnings and cash flow generation. Estimates of nominal GDP keep rising, which should support earnings growth. Russ joins us now for more. Russ, let's get into the earnings story first, sir, and it's good to see you as always. If you missed this week, in fact, in this quarter, this reporting season, you get punished, and it doesn't take much of a miss. Russ, what do you make from that? What is the signal that you take away from it?
Well, good morning, Jonathan. I think the short answer is the market's moved a good deal off of the October lows from last year. We've got some crowded trades, and this is an earnings-driven market. You know, you think about 2023, that was all about repricing. It was all about multiple expansion. And because of that, as you pointed out a moment ago, the market is not cheap. And this is a year where stocks are going to be driven much more by earnings, by cash flow, by profitability. If companies are not showing investors what they like, you're right, they're getting punished very quickly.
JP Morgan, Marko Kolanovic with this to say: earnings expectations are too optimistic. Russ, you appear to take the other side of that.
Take the other side of that, and there are a couple of reasons. First of all, I do think you've got a number of companies, we all know who they are, that are dominant in the indices that are tremendous at generating cash flow. They've got moats around their business. They are levered to long-term themes, whether that's artificial intelligence, internet commerce, and I think that continues to be a long-term trend. But the simpler answer for most of the companies is that ultimately the top line is going to be driven by nominal growth. And you think about what's happened. You know, you go back to last year, there was still a lot of calls for a recession. And now we've got estimates for 2024 GDP at 2.4%. Inflation obviously is a little bit stickier than everyone would like. But you add that up, and you're likely to get a year where nominal growth, nominal GDP is 5% or north. That's a pretty good environment for earnings. What's expected right now is 244 for the S&P 500. That's around 10% growth. I think if you get 5% nominal GDP, that is a very attainable number.
Russ, I get that, and I get why stocks would do well in that environment. But here's the thing that confuses me, is that small caps haven't been. Earnings growth is something like 0.3%. They're underperforming the market. If growth is lifting all tides, why not the small cap tide?
Well, that is a great question. And I think there are a couple of reasons for that. The first of which is this has become, I think, as we all know, very much, for a lot of industries, a winner-take-all economy. So the growth you're seeing, the earnings growth you're seeing from some of the large companies, from some of the Magnificent Seven, that is a multiple of what you're getting for smaller companies. The other reason the small caps have struggled, you know, remember, they had a decent rally, actually a very good rally in November and December. Why was that? Well, back then, rates were heading lower. One of the things that has reasserted itself this year is this notion of rate beta. Parts of the market that are more sensitive to rates, and whether you're talking about small cap or early growth companies, they've had a much tougher year. Not that rates have skyrocketed, but we've seen nominal real rates up 50, 60 bips. That, I think, is having an impact on certain segments of the market, definitely small caps.
Russ, you also like credit, but Bank of America had a note out earlier in the week basically saying a record amount of high-yield bonds are trading like IG. Does that not worry you?
Well, I think there are concerns about where current spread levels are at, but I go back to a couple of things. One, a lot of the credit we have in the portfolio, we bought when spreads were much wider back in 21 and 22. We're not adding significantly to it. There are parts of the market that are interesting, but basically, you know, we're clipping that coupon, which is creating for the first time in years a very nice tailwind in a multi-asset portfolio. But the other thing to note is, again, going back to that nominal growth argument, if we are in an environment where nominal GDP is going to be, again, let's call it 5% or north, where a lot of companies, both in IG and the high yield space, termed out their debt several years ago, I think that's an environment where we can expect that the default rate is going to stay low, as it has been for a while now.
Russ, given what you expect nominal GDP to look like, does that keep you away, steer you away from duration in government bonds?
I think it depends on the part of the curve. You know, Jonathan, as we've spoken about, we've been modestly underweight duration for a long time, and we're keeping that. Now, it's not everything. You know, again, as I said, we've got an overweight to credit. There are parts of the curve, whether it's the short or the belly, that we think look more reasonable. But yes, we have been more cautious on the long end of the curve. Several reasons for that: the stronger growth environment, the fact that inflation has remained sticky. And as we've spoken about, while it's more of a longer-term issue, you've got to be a little bit cognizant of the amount of supply coming into the market, particularly when it comes to Treasury.
So, Russ, with that in mind, within the portfolio, where do you find risk mitigation at the moment? Because you're underweight duration at the long end, okay, one. Two, you're underweight defense. Top of the pile there seems to be staples, don't like those. What do you like on the defensive side of things?
Well, you know, this is a great question. And I'd say one of the challenges now in a multi-asset portfolio is your hedges become more difficult. There were a lot of challenges last decade, but when your concern was always low growth rather than inflation, the hedge was fairly easy. You bought long duration, and that worked remarkably well for over a decade. And to your question, I think it's a tougher call now. So there is no one single asset I can give you. I'll give you a couple strategies. Generally, being long the dollar, at least against the euro, has worked in an environment where often when the market sells off, you're most concerned about the Fed. Using volatility as an asset class, using vol when option prices are cheap, that's another way to manage your downside risk. And the last idea I'll throw out is this notion of having high-quality stocks as a self-hedge. Looking for, again, a lot of those companies with high profitability, with margins that are consistent, not that they can't go down, but on a relative basis, we think they hold up better than the broader market.
Russ, right now, though, is the moment where volatility is cheap. It is extremely cheap, decade lows by some accounts. People aren't buying it. People aren't looking for protection there. What gives?
It's a good question. I can't really answer that other than we have an environment where people are still looking for risk. And the other thing to note, which we haven't spoken about, is one of the factors that probably supports the market going higher, beyond earnings and beyond rates, is simply the fact that there's still a lot of cash on the sideline. And particularly as we get to a point later in the year where we do think the Fed will cut, albeit later than people thought and hoped, some of that money is likely to come back into the market. So I think part of the reason people may not be looking for protection as much as they might is there's still a lot of cash to be put to work.
T-bills and chill. Russ, let's finish on that. You mentioned a couple of rate cuts. Is that enough? Is that sufficient to unlock all that money parked in money market funds?
Well, I certainly think, 2 rate cuts is different than the 7 or the 6 that we expected back in the beginning of the year. But I think the market can live with an environment where growth is strong, and maybe the Fed only cuts a couple times. And, one of the things that is helped this year, rates have moved up, but generally the move has been contained. Rate volatility has come down. So if we get a couple of cuts, yes, I think the short answer is the market can live if we just get 2 cuts this year.
Hey, Russ, good to hear from you, buddy. As always, Russ Kostrick there of BlackRock breaking down this market. We've been starved of data this week. It picks up a little bit at 8:30 Eastern time. We'll get jobless claims. The estimate 212, the previous number 208. Fast forward a week, Danny Berger, and then we can get real about real data. CPI retail sales the same day, May 15th.
You know why it's frightening for this market? Because earnings season is largely going to be over. We're not going to get a Fed decision for a while. So what happens with each data point where we don't know what the Fed is going to do? It is lots of volatility, which, oh, by the way, a market that's not very well hedged, to Russ's point, it can get scary on days like that.
Retail sales fascinates me. Just how is the consumer doing in America? If you take Starbucks, not great. You take the theme parks of the Walt Disney Company, tremendous. Where is the U.S. consumer right now?
Well, clearly not drinking your lavender lattes. That has been made extremely clear. I don't know, it's the whole thing of the shift of, oh, they want experiences, oh, they want this. But there is this degree to which the lower consumer, the lower class, the one who's going to McDonald's is the one who is not spending. It is this bifurcation of the American economy we continue to see.
Talked about that a few times. Mike Wilson, Morgan Stanley, upper end stability, lower end fragility. Equities right now, a little bit fragile. Relative to the stability we've had over the last week, we're negative here by 0.2% on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Shonali Basak. Hey, Shonali.
Good morning, John. Shares of ARM falling in the pre-market. The chip design company gave a lackluster revenue forecast for the year, raising concerns that the tech industry's AI spending spree might be slowing. 3 months ago, an upbeat forecast sent ARM shares soaring and helped turn the company into an AI darling on Wall Street. The stock was up 41% this year through Wednesday's close. And living in Manhattan is getting even more expensive. Apartment rents rose to a new high for April. Leases were signed at a median of $4,250, up $9 from the same time a year ago, according to appraiser Miller Samuel and brokerage Douglas Elliman Real Estate. Rents have climbed annually in 3 months of the past 4 months, suggesting another record-shattering summer to come. And MAGA has joined TikTok, the Political Action Committee, or PAC, becoming the first Trump-affiliated account on the Chinese-owned social media app. The Super PAC's first videos, posted under the handle MAGA, attack President Biden's economic record and label independent presidential candidate Robert F. Kennedy as a, quote, radical leftist. Trump and Biden, who have been on TikTok since February, have both supported a ban on the social media app over national security concerns. And that's your Bloomberg Brief, John.
Hey, Shonali, thank you. Much more from Shonali in about 30 minutes' time. $42.50 median rent in Manhattan. Just absolutely ridiculous. Up next on this program, Biden's warning to Israel.
I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
It's quite a warning from the President of the United States. If they go into Rafah, I'm not supplying the weapons. That conversation up next.
Could face bigger challenges next.
Was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
It is Thursday morning. Good morning to you and welcome to the program. Equity futures on the S&P 500 just a little bit softer, down here by 0.2%. Yields a touch higher, up by 2 basis points on a 10-year, back through 450, 451.21. Under surveillance this morning, Biden's warning to Israel.
They go into Rafah. I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks. But I've made it clear to Bibi and the War Cabinet, they're not going to get our support if, in fact, they go in these population centers.
So here's the latest this morning. The president delivering his most public criticism to date about Israeli military actions in Gaza. Biden warning the delivery of additional weapons may be delayed if Israel continues a ground invasion of Rafah. Israel's Prime Minister Benjamin Netanyahu has yet to respond. Let's head down to Washington, D.C., where Anne-Marie is joined by Ed Mills of Raymond James. Morning, Anne-Marie.
Good morning, John. That was the strongest warning yet we've heard from this administration regarding the military weapons that they have been supplying Israel. Ed, what do you make of that? Because yesterday we talked about this in the context of this is just a pause. Now this sounds definitive.
So the thing I make of this is that there is an election in November, and that President Biden is looking at the polling data and shows that geopolitical risk, any rising tension, is a significant headwind to his reelection. And if you have Israel expand the war after he signs into law a kind of defense supplemental and is transferring the weapons to Israel, he owns this much more. And politically, that's impossible for him to withstand. And so this is a closest to a red line as we are going to get from the Biden administration.
How does he do both, though? He also said in that interview, he talked about the Iron Dome. He continuously says his support for Israel's ironclad. And in the same breath, he'll also say something like, quote, we're not going to supply the weapons and artillery shells.
So, Anne-Marie, I think most of life is what I call a both and. It's both strong support for Israel and conditions, especially when it is U.S. taxpayer dollars coming here. I think what was also really important in that interview is that he was discussing after there is a ceasefire, how does Gaza get rebuilt? Different Arab neighbors of Israel. One of the things that we've heard a lot from our contacts here in D.C., and we've talked to Raymond James clients about this, is that I think the Biden administration is also looking at Saudi Arabia as a potential longer-term solution. Can they normalize relations with Israel in exchange for Israel recognizing a Palestinian state? And so that's also a both and. They're dealing with the immediate conflict, but are also looking at what comes next, what's the rebuilding, what could be the legacy of this administration.
We know the direction of travel the Biden administration wants this story to go. The issue is, how do you get there? Because if they're saying they're not going to provide the military weapons that say Israel says they would need to eradicate Hamas, how do they get from point A to point B?
I think it's a very thin kind of line that you have to walk. I do think that immediately, I think the concern is the humanitarian issues within Gaza in an attack on Rafah. I think this is an administration that has been desperately wanting a ceasefire. There's obviously clear concerns within Israel about any continued control of Gaza by Hamas, who launched the terrorist attacks on October 7th. So it is trying to kind of work all diplomatic angles, trying to de-escalate the near-term situation to put together a long-term solution that actually works.
How much of this is about what is going on at college campus and the protests and the Gen Z, the youth vote that Biden needs to secure for November?
So, Anne-Marie, that's exactly what I talked about at the beginning here, which is we've seen in polling data that the Biden administration or Biden himself was doing quite well after his March State of the Union address. But with the increase in geopolitical risk, with the college campuses demonstrating, you've seen a rebound for former President Trump in a lot of polls, especially in swing states and especially among younger voters. The cratering among younger voters for President Biden is an alarm bell for his campaign. And so he cannot see an expansion and having a humanitarian crisis that expands within Gaza and probably win those voters over and win in November.
Also an alarm bell is the economy. Quinnipiac polling came out yesterday, just looking at Wisconsin, where Biden sat down and gave this interview. And they continuously give Trump higher remarks for the economy, and they rate the economy as the #1 issue. Now, I want to talk about taxes going into next year, because yesterday we heard from the CBO, if those Trump-era tax cuts come back and are extended, it's going to be $4.6 trillion added to the deficit.
Yeah.
How is this sustainable? Because this is what the Trump campaign is campaigning on.
So I think what was remarkable about that $4.6 trillion estimate, the last estimate from CBO was only $1.1 trillion. So this is ballooned. We also heard yesterday from the chairman of the House Ways and Means Committee, a Republican on the tax writing committee, that he's talking to his colleagues. And a number of Republicans, Anne-Marie, are saying the corporate tax rate might have to go up. And so the market has expected that if there were to be a Trump victory, Republican sweep, that all of this gets extended out. But at $5 trillion, it's becoming less and less likely. January 1st of next year, we have the restart of the debt limit. So will the bond market allow Congress to lift the debt limit and then maybe cut taxes by another $4.6 trillion over 10 years? I'm getting increasingly skeptical. And for Democrats, if they're in charge, if they do nothing, taxes go back to where they were under Barack Obama, and on state and local taxes, that $10,000 cap goes away. And so a lot of clients that I talk to are like, well, $1 trillion tax cuts for New York, New Jersey, California, Massachusetts, Wisconsin. There are a lot of Democrats in this town that says doing nothing and not spending that additional $4.6 trillion might be the preferred path, especially if Democrats win.
If Republicans are voicing concerns about the corporate tax rate and they want to potentially come in line with the Democrats and raise it, what can you see in terms of the extension of these tax cuts? What's the base case?
So I think the base case is most things get extended under Republicans. Most things go back to what they were under President Obama, under Democrats. There are a couple things that need to be dealt with. First and foremost, the pass-through for small businesses. There will be a huge differential if we don't do anything there. Probably raising the standard deduction so that most people don't have to itemize. Something on rates, especially for lower end kind of income households. They could do a short-term extension. We talk about these in 10-year numbers, and that's $4.6 trillion. Nothing stops them from doing 1 or 2 years, because when Congress has an option, they like to take the least difficult option. So especially if there's not a majority kind of across the board for Democrats or Republicans, doing something 1 or 2 years is going to cost a whole lot less, and they can get that done.
Finally, Ed, if you're seeing already cracks within the Republican Party and people talking about, well, actually, even if Trump gets elected, even if we get a sweep, we might want to actually raise the corporate tax rate. What party, when you're at Wall Street, you're looking down to Washington, what party is more favorable for big business?
Well, Anne-Marie, it really depends upon what part of business that is. And, you know, we even were having conversations with a lot of Raymond James clients about kind of defense stocks in the defense supplemental. And normally you would say Democrats are kind of skeptical, Republicans are good for defense spending, but it was the reverse in the defense supplemental. We look at China and tech restrictions. Trump could come in and ramp that up, and that would be much less predictable. On taxes, you know, historically, Republicans have been more favorable, and they are more likely to extend some of this out, but it is not a one party good, one party bad anymore. It's a lot more nuanced, which gives me a much more interesting job.
Ed Mills, Raymond James, Washington policy analyst. Thank you so much for joining me this morning in Washington. John, big fights ahead in 2025, especially those tax cuts, especially when you come to Washington, you hear Republicans are talking about their concerns and that they actually potentially want to raise the corporate tax rate, which is what Democrats want to do.
MH, a busy 6 months ahead for you down in Washington, D.C. Much more from Anne-Marie a little bit later. So much has been said about the situation abroad and what it means for the president's re-election chances come November right here at home, particularly in places like Michigan. Go through the polling. Bloomberg News Morning Consult. Think about Michigan just for a moment, okay? He's down 7 in Arizona. He's down 6 in Georgia. He's down 10 in North Carolina. He's down 4 in Wisconsin. He is up against the former President Donald Trump by 2 in Michigan. It's not about foreign policy. It's about the economy.
It surely is, and he has the advantage of Trump being tied up in New York, so he can go and make these trips while Trump can't. But is it the right message? Is it the right message to tell people, no, you are doing better than you think you are?
Much more on the economy with the former World Bank President David Malpass sitting down with AMH in Washington in the next couple of hours. Don't miss that. Don't miss this. Sarah House of Wells Fargo looking for a softer CPI print next week. The look ahead up next.
that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Equity futures here negative by 0.2% on the S&P 500. Just a little bit of a pullback on the S&P 500 following yesterday's day of basically unchanged price action, going absolutely nowhere. On the Nasdaq 100, we're down 0.2%. The Russell's had a decent run. We snapped that. We're down another 1/3% on the Russell 2000. If you switch at the board and get to the bond market, yields lower for 5 consecutive days into Wednesday, then yields a little bit higher and back through 450 this morning, up a single basis point at 450.42 on a 2-year, just about unchanged at 484.27. Plenty to talk about in foreign exchange. Before we get there, just a couple of notes for you. Later on today, we'll hear from the San Francisco president, Mary Daly. Look out for that. 8:30 Eastern, jobless claims. Look out for this. Dollar yen, 155.91. We're looking at 156 all over again. Danny Berger, they got a problem over in Japan.
They do have a problem, and it is made abundantly clear by the fact that Ueda and Kushida spoke to each other. It's a problem for people who want to go abroad in Japan, maybe not for people who want to travel to Japan and spend money there, but it's also a problem for importing. It is a government problem, therefore it is a BOJ problem.
How many people are going to Tokyo that you know? That's all I hear about.
Yes, so many. I'm ready to go. I'm ready. It's cherry blossom season, John. I'm ready to go.
What do they call that? Momiji-gari, I think, is leaf peaking over in Japan.
You know more than me.
Something like that.
All I know is there's a great view of the Shibuya crossing at the Starbucks. That's all I got for you.
Okay, we'll try and figure this out. Let's look at sterling just briefly. We are about 29 minutes away from that Bank of England decision. 124.96 on cable, totally unchanged. Look out for the vote. The evolution of the vote. Danny, I think that's what we're looking for, right? Basically, you had a couple of officials 2 meetings ago still calling for hikes. They've dropped that call. You had one official still calling for a cut. We're trying to work out whether that official gets some company in about 30 minutes' time.
Yeah, it would likely be David Ramsden, because he came out and basically said, I'm less concerned about inflation. You compare that, though, to Hugh Pill, who says, I have the same view I did in March. And that view, of course, was that rates still needed to be higher than longer. So regardless, we know it is a split MPC, but that matters more, of course, than what Andrew Bailey says, much to his chagrin. We care more about those individual members than the man himself.
We're looking for the breakdown of the votes in about 28 minutes. The Bank of England decision just around the corner. Here are some of the top stories for you. Under surveillance this morning, President Biden sending a warning to Israel. Biden telling CNN he will delay more weapons if Israel continues with a ground invasion of Rafah. The comments coming after the US already paused the shipment of about 3,500 bombs. The warning was pretty clear. I think the president's very clear-eyed about what could take place here. If they go into Rafah, I'm not supplying the weapons.
And went on to say that, yes, these weapons have been used previously to kill civilians. One of the interesting things about this, the Wall Street Journal reported that originally Biden had hoped that this would be under wraps, that he would negotiate with the Israelis and the public wouldn't know about it. Biden is someone who's given very few media interviews recently, something that he's been very criticized about. So the fact that not only is he not doing these negotiations behind closed doors, but he's using one of his few interviews to talk about it and send a message.
We mentioned this yesterday. Think about what's on the table. 3,500 bombs, which could be used to target one of the most densely populated areas on the planet. We're talking about Rafah with more than 1 million Palestinians. Can you imagine the devastation and damage that could be done there and the headlines back home going into November?
Biden can't have that. He can't have that. He's already had the youth vote turn against him. You already see what's happening across college campuses. Whether you think it's right or it's wrong, the impact is one that the Republicans can say, look at the lawlessness, look at the commotion that Biden has basically made come to the fore. One of the ways he gets that settled is by something that creates a ceasefire, and weapons, that is the tool, right? That is the tool that America can use.
And that's the latest on the Israel-Hamas war. Here's the latest in Japan. We mentioned it briefly. The BOJ Governor Ueda using tougher language on the yen after a meeting with Prime Minister Kishida. Ueda telling the PM he's carefully watching the impact of a weak yen on prices, then speaking at an event saying abrupt and one-sided weak yen moves raise uncertainties and are negative for Japan's economy. There was a quote, Danny, from Kit Jukes in the last 24 hours, and Kit, as always, over at SocGen, absolutely nailed it. Yellen's observation that FX intervention should be rare and accompanied by consultation will embolden yen bears. And I took away the same signal over the weekend.
And also just the idea of they continuously say, look, when it deviates from fundamentals, that's when we're concerned, the one-sided bet. Well, if you're a yen bear, you'd say this is fundamental. The bond market is volatile. We're going in and we're going to push this and see if we can get it to 160. But the thing is that this is a change of language in only 2 weeks. And this gets to the point of credibility. If he's changing his tune so quickly, if you're a yen bear, you'd say, why would I believe you this time around?
This started to brew, I think, at the IMF World Bank meetings a couple of weeks ago. You could hear the complaints, not a big response from the president, no response so far, but getting more of a response from the Treasury Secretary, Janet Yellen. Fed President Susan Collins adding to the higher for longer narrative, Collins saying, quote, the recent data leads me to believe this will take more time than previously thought. Investors looking ahead to CPI next week. Sarah House of Wells Fargo saying this, excluding food and energy, we estimate prices rose 0.3%, which would break the streak of 0.4% gains since January and push the year-over-year rate down to 3.6%, a 3-year low. Sarah joins us around the table for more. Sarah, good morning to you.
Good morning.
Is 0.3 good? Is that a good thing?
It's certainly better than what we saw the past 3 months, where we had that string of 0.4 readings, which surprised to the upside. So I think it's at least a step in the right direction of resuming the journey back towards the Fed's inflation target. But at the end of the day, I think that's still a bit strong, but it's at least improvement from what we saw in the first quarter.
Does it open the door to a conversation about July? Or has it not come soon enough?
I don't think it's strong, and I don't think a 0.3 print would be enough for July, just when you think about the data calendar. And I think really you probably need to see, at least on the CPI front, probably set core numbers closer to 0.25s, I think, to keep even a September rate cut in play. So April is going to be the first step to, I think, keeping the door open to even a September cut at this point. July is going to be pretty tough unless you see a market weakening in the labor market.
We had Kathy Jones at Charles Schwab in your seat yesterday, and she alluded to the fact that maybe Q1, for her at least, the strength might have been a bit of a head fake. Would you go with that?
I think there's the potential for some residual seasonality there, where you just saw such strong pricing at various different points in the year that the seasonals are maybe not fully accounting for the typical early year strength, but they still do anticipate more strength in the early part. And so I think there's still some signal in the firmer readings, and I think it's also possible that it's catching up for the second half of last year, which was a bit of a head fake in itself. So kind of smoothing that out, we're still looking at overall core inflation still probably going to be 3.6, even with some downshift in April.
It feels like every piece of data is a head fake. Every piece of data we have to evaluate, is this really the trend or is it not the trend? That's obviously not how the economy works, though. There is some sort of trend, though. So with each piece of data coming in, can you get a clear read at this point? Can you have conviction in your calls right now?
So I think the second quarter numbers are going to be very important, since Q1 was so messy, whether we're talking inflation, whether it was talking maybe payrolls, even ECI. And so Q2 is going to be really important for how much of that was noise or signal. But it does make it difficult to, I think, really have a lot of conviction in terms of what's not necessarily the direction, but at least what's the magnitude, what's the pace of whether it's inflation, whether it's job growth, whether it's the overall economy.
Well, if the magnitude and the pace is a slow one, going in the right direction, but perhaps not picking up or going as fast as the Fed would hope, is that enough to say that policy isn't tight enough?
So I think when we step back and think about how restrictive is policy, it's in part the inflation data, but I'm also looking at the growth data to tell me that. Inflation is a lagging indicator, but I think what makes me question the degree of restrictiveness is really the strong activity data that we continue to see coming in, at least the underlying components of GDP, some of the consumer spending numbers. That leads me to question it a little bit more than inflation. I think if you do see a downshift in activity, that's also going to help inflation, along with, I think, some still long tails of some of the supply dislocations that we've seen over the past couple of years.
There has, though, been some anecdotal evidence, perhaps, of weakening growth, of weakening consumer, be it everybody flocking to buy now, pay later, be it Starbucks, McDonald's, surveys. How much do you pay attention to those sorts of pieces?
Yeah, I think they're really important at this juncture where we're looking for any pieces of data, especially given timely reports like that. I think anything that helps us parse out what's happening across different segments of consumers is really helpful. So we know higher income households are doing better. They haven't been as impacted by rates when we think about what their mortgage payments are, things like that. And so that's really helpful in terms of, are we starting to see some pushback in terms of that pricing? Because there's not a lot of great indicators that check the degree of pushback. We can get things like the NFIB pricing plans, but that doesn't really get at, well, we're having trouble actually passing on those prices, and we're going to hold back a little bit more.
Here's a read on things. So you mentioned buy now, pay later. Fantastic story from our colleagues at Bloomberg News overnight, with a Harris poll that found 43% of those who own money to BNPL services said they were behind on payments. 28% said they were delinquent on other debt because of spending on the platforms. Can you help me understand if we're getting an accurate read on what's happening with the US consumer at the moment because of maybe some of these places that aren't gauging things?
Yeah, so I think that is one of the pieces that it's been harder to get an eye on. So my colleagues, Tim Quinlan and Shannon Grin, have talked about this is the phantom debt component, but I think we're seeing still that stress in the consumer that I think is also indicative of what we're seeing in the buy now, pay later, just in terms of the credit card delinquencies, as much as they've risen back to the highest rates since 2008. What we're seeing in terms of the credit card rates, these things are correlated. And so I think even as we don't have a great line of sight on that, you are still seeing that stress in certain segments of consumers.
This speaks to what Danny's talking about, which is whether we are sufficiently restrictive or not. Plus, where we end up, where is neutral, and why is this Federal Reserve not engaging in that conversation in quite the same way the market participants appear to be?
Yeah, so I think at the end of the day, we don't know exactly where neutral is. It's unobservable. We only know it in hindsight. And I think given the uncertainty around it, that's made it difficult for Fed officials to really engage with it. But we are starting to see that more. You saw Kashkari earlier this week talking about he's thinking neutral might be higher, and that's why financial conditions might not be as tight as he would have expected. And we're starting to see it in the dots too. You've seen that the median drift up, but even more so the average. And so I think there is a lot more thinking about that, even if it's not front and center.
Well, this gets to the Mohamed El-Arian argument, which is basically you can't get back down to 2%. Not that you can't, but you shouldn't, because in order to do it, you cause unnecessary damage to the economy. Is that right? To actually get back to 2%, it would be extremely ugly in this American economy.
Well, we've seen, I think, obviously a lot of supply help in this on this front, but I think we are in a harder part of the cycle where if we look at labor force growth, that's grown close to 2% each year of the past 2 years, but now you have things like prime age participation, close to the highest it's been in 20 years, signs of leveling out, and so I think it's going to get harder to see those additional supply side gains we've seen supply chains returning to a more neutral level. So I think this next phase of the inflation fight, it is going to require more pain and I think a bigger hit to demand than what we've seen over the past year or two.
You've been talking about that for a while, the last mile, the hardest one. Sarah, thank you. It's good to see you, as always. Sarah House there of Wells Fargo. Looking ahead to some data next week, CPI on May 15th, alongside retail sales a little bit later this morning, 8:30 Eastern Time. Jobless claims. The estimate in our survey, 212. The previous week, 208. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. The bundle is back. Disney and Warner Brothers Discovery announcing that they will sell their biggest streaming services together starting this summer. Subscribers will have access to Disney Plus, Hulu, and Max, both the ad-free and ad-supported versions. The companies have not given a price for the combined service, but similar offers typically come at a discount to individual subscriptions. And Elon Musk is closing in on a major funding round for his AI startup. XAI is set to be valued at about $18 billion when the round closes as early as this week. And that's nearly triple what had been estimated, with Silicon Valley firm Sequoia Capital contributing to the valuation. A source saying that the platform will be able to train from data on X to help build its language models, and ultimately it aims to compete with OpenAI. XAI currently operates the chatbot Grok, available on X. And Real Madrid will meet Borussia Dortmund in next month's Champions League final in London. 2 late goals from Madrid sealed a 2-1 win over Bayern Munich to advance to the final, where they'll look to win their 5th Champions League title in the past 9 years. Earlier, Dortmund beat PSG to advance to their first final since 2013. And that's your Bloomberg Brief, John.
Shanali, thank you. Just leave the picture of that man right there up. Carlo Ancelotti, the manager of Real Madrid, 4-time winner as a coach, twice as a player over at AC Milan back in the days. Absolute legend. What a finish it was going towards the end of that game just yesterday. That's enough of that. Up next on the programme, traders looking for doves at the BOE.
I don't think in the UK we have felt the maximum impact of past monetary policy tightening. So I think there is a clear possibility that BOV could actually deliver more easing that the market is currently pricing.
The conversation up next, that rate decision, about 15 minutes away.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage, because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice, saying, put your hand up for the most difficult job. Put your hand up for things that are challenging.